Hello, everyone. Good afternoon. Good afternoon. This was my first time setting up this YouTube live. So, for the past minute and a half, I thought I was live and I clearly wasn't. Can you all hear me properly? Can you all see me properly? Give me a thumbs up if you can in the comments. Can you all hear me, see me properly? Give me a thumbs up. Perfect. There you go. Because for a minute, I was just talking to myself. I hadn't started off. I was waiting for a minute for everyone to trickle in. And here we go. Here we go. Very excited for this. And here's my promise to you, right? At the end of this masterclass, you're going to know what are SIPs, how to start one, and more importantly, I keep getting DMs every single day, which funds to invest in. So I'm going to be sharing everything with you. I'm going to be sharing where you can invest, how to go about it. Later on, as a part of the resources, you'll get a step-by-step guide. So we won't waste time with regards to the logistical aspects of it, but the knowledge aspect of it is what we will be focusing on. So here we go, right? This is my promise to you. At the end of this very session, you will know how to start an SIP and know which mutual fund to invest in, no matter what your goals are. A lot of people always confuse mutual funds with long-term investing for retirement, for education, to buy a house that is 5-6 years away, but that is not the case. You can invest in a mutual fund, you can invest in an SIP, and also at the same time invest for 2-3 years, 1 year, 6 months at times. So here we go. Give me 1 second. There will be a recording available for people. I'm getting some questions here. There will be a recording available, but that we'll give it. We'll have a live replay instead of a recording. We'll have a live replay later on. Just give me 1 second. This is my first time with a YouTube live, so I'm just a little lost. But there you go, right? So can you see this now? And you can use SIPs for every financial goal that you may have. It does not matter. It does not matter who you are, right? You could be a student, you could be a parent, someone with a new child at your first job. You could be young and single, married, planning for retirement, vacation, scared of investing for the first time, or you've been investing but didn't have the best experience with it. You could be any one of that. But still this masterclass and this knowledge would be relevant to you because I actually work with all these people who are new parents, students, people who have just started their first job, people who want to plan for their kids' education, for their elderly parents. And that's because I have actual real experience of handling real client money. And the idea and the word influencer, I don't really like it when people say it because even before we started putting up videos online, right, about 18-19 months ago, there was a full-fledged wealth management practice behind it. We still manage people's wealth. We still help people with insurance. So this is one of my favorite quotes from L.H. Hardwick. It goes something like, a man with an experience is never at the mercy of someone with an opinion. So having said that, let's get started. Now here's something that absolutely changed my life. Very early on, when I had just started working with people to help them manage their money, to help them figure out how to go about investing. One of the very first clients said these words to me. She was 59 years old at that point, would turn 60 in a couple of months' time. And she told me, I want to visit my son once in the US. Yeah. Government employee would draw a 25,000 rupee pension, middle class by all aspects, right? Had about 40-45 lakhs through gratuity, through PF. And her only goal in life, apart from that pension that she would get, was to visit her son once with her own money. And she did not think that was possible. I went back to her after a couple of days. And at that point, I told her that you can not only visit your son once in a whole, but you will be able to visit him once every 2 years with your own hard-earned money. And the moment I shared that, she had the biggest, widest smile on her face. And the moment she actually realized that the money that she has is enough to do that, her life changed. She was very thankful to me, and I wasn't making optimistic projections. I am a very pessimistic investor in general when it comes to money. And at that point, I realized the true value of what good money management can do. Because if you can manage your money well, it really gives you agency over so many things in life. And you don't need big amounts to do it. If you're very strategic about it, it can be possible if you just go about having some sort of a foresight. And the entire idea of this masterclass is to help you get that. The moment the moment I saw how happy she got, I knew this was the profession that I wanted to be a part of. And over the past 18 odd months since I started putting up videos online, I realized a lot more people I'll have the ability to share all this information with a lot more people. So keep that in mind, that all your SIPs are literally one goal away. I'm not exaggerating when I say that at all. You want to save for a vacation, you want to save 1,50,000 in a year, 2 years time, that is possible. You want to buy a house, you want to buy an iPhone, kids education, retirement, again, all of it is possible through an SIP. And here's something I want to quickly share with you before we get into the actual nitty-gritty as to how to go about all of this. So first up, if you notice, there you go. So if you notice, if you have a 30,000 rupee SIP, right, the first 50 lakhs is going to take about 8 years and 3 months. The next 50 lakhs you're going to get there in about 4 years. So in reality, first 50 lakhs, 8 years, second 50 lakhs, only 12 years. The third 50 lakhs takes even lesser. It takes 15 years and a month. And if you think about it, once you have a corpus of about 3 odd crores, you start making 50 lakhs every single year on that investment. And that's what ends up happening when you wait for your investments to grow. You're patient, you're witnessing the magic of compounding. At the same time, every single time I share something like this on social media, and rightly so, I'm asked, but what about things that we want to pay for 1 year from now, 3 years from now? Okay, great, I'll have 10 crores, 15 crores many, many years later, but what about something that will be happening immediately? And hold that thought for a second. I'm going to get into how that would be possible as well. Broadly speaking, you have two methods to invest. One is to invest for a very specific goal, and then you can invest by having all goals in mind. Are you guys able to see my screen? Suraksha is saying she can't see my screen. Are you able to see my screen? If you are, give me a thumbs up in the comments. Give me a thumbs up in the comments if you can see. Yes, you can. Okay, superb. All right. Thanks, Vaishnavi. Thanks, Pawan. Thanks, Kaushik. Darshi. Chandra is saying I should give a little introduction about myself. If you want me to give a little introduction about myself, give me 2 thumbs ups in the comments. And I'm going to get into it in 1 or 2 minutes at the most. Okay, 1 or 2 minute introduction is coming up. So a lot of you know me through Instagram, know me through the videos that I share with all of you every single day. I started my page in 2022 August, very social media shy, never ever thought that I would be sharing videos online. I'm 29 years old right now, had my birthday a few days back on the 20th of April. And I've been licensed in the financial services space since the age of 20. So that's about since 2015. And I started off by working in insurance, That's where the first license was. And since 2019, I've been actively involved in helping people manage their mutual fund portfolios. And somewhere along the way, despite me being social media shy, I realized that if I can share the information that I've gathered by actually talking to real people who are dealing with real money problems, then that has the potential to change someone's lives. And the moment that realization occurred to me, I knew that this is what I wanted to do. And then sharing videos just became something that I started loving after the first 2-3 times that I posted. Currently, we work with about 150 clients on the investments front. And on the insurance side, we work with over 200 people. And we have done pro bono consultations that a lot of you have taken as well. Over 1,1300 now. So 1,1300 free consultations. And we actively work with over a group of 200 people. Aniket Deshpande, you're asking, why are you doing it for free? The entire idea of this is that the actual value transfer that would happen, A, would be immense. Number two, the most common question that I get asked is where to invest. And this entire masterclass, the idea is to get into the nitty-gritties of that. So having said that, I'm going to get right into it. I'm going to share my screen once again. Give me 1 second. All right, here we go, right? So if you want to invest for specific goals, just bear with me for 1 second. I'm going to share my entire screen so that just give me 1 second, please. The idea is to open some Excel sheets and calculators so we get into it right away. So just give me 1 second though. Anuj Nagpal, you're saying that, would you share a few mutual funds? Yes, we are. Just bear with me for 1 second. This is my first time navigating through a YouTube live where I am sharing something like this. So I'm just finding my way around it. If you can just bear with me for another minute at the most, I will tell you what we can do. Mohit, how's the Josh? Okay, so can you see this? Okay, here we go, right? So how can you invest for a very specific goal? There are two ways you can invest, right? You can have a specific goal where you want to only save for it. It could be, let's say, I want to go for a vacation, or I want to buy an iPhone, or I want to have money saved up for my marriage in a couple of years' time. It could be something very specific. That's one way to invest. The second way is you figure out, okay, I have 20,000 rupees at the end of each month, or I have 50,000 rupees. And now how can I go about using that entire amount to save for everything that I want to, whether it is, again, all these short-term goals or even long-term goals like your retirement, or you want to buy a home after 5-6 years. So initially, let's quickly tackle what you can do if you want to invest for a very short-term goal. So let's say the goal is, and you can, again, all these resources will be available to you. So you can put in your numbers, input your numbers, and figure out what you need to do. Here you go, right? So let's say you want to save for your marriage 2 lakh rupees after 1 year, or let's say after 2 years, and inflation is about 7%. We can also increase inflation, the amounts will go up. Then how much do you need to save through an SIP per month? About 10,000 rupees. Now, where to invest this, we'll be covering in the second part of this masterclass, because we need to warm up to that level. Because if I just give you names, right, invest in this mutual fund, you're not going to have the confidence to actually go out and invest. So for me to get you to that level, it's going to take some time and it will be worth it entirely. So that's one way that you can invest. What about if you have multiple goals in mind? Okay, I just want to check if my screen is getting shared. It is, right? So what if you have multiple goals in mind? And this sheet here, once again, will be given to you. In this sheet, I'm going to first just zoom into this particular segment, which is how much SIP you can do today. It could be any number. It could be 30,000, 20,000, 10,000, 1 lakh. You can just enter that amount. What is the return that you estimate on it? What is the annual step up? Annual step up means every year you increase your SIP amount by that percentage. You can also make this 0. You can keep it 5, 10, 20. It's up to you. It's very customizable. And how long do you plan to work for, or how long do you plan to keep investing? And at the end of it, you will know how much money you have after 30 years. But the beauty of this sheet is that it tells you that you can spend for various things while you get to that retirement age. Like, for example, here you go, right? Starting from the age of 34, you can take out 50,000 rupees every single year. And you can use that. I've considered a vacation here specifically, but it can be for anything. Again, you can just change this number and it will automatically give you the inflation adjusted values right here. So basically, you're taking out this 1.21 lakhs, which is the inflation adjusted value of 75,000, and you can just take out this amount of money in the future. You can also change inflation values so that the number that you take out changes, but let's just keep it at 10%. Always or on the caution of or on the side of safety and caution when you're doing anything like this. At the same time, you can buy a car. You can pay for this down payment, a 30% down payment. We'll get into the details of this sheet and what exactly is happening, because if you notice, it also has things like education costs 50 years later, right? So if you have 2 lakh rupees that you need 20 years later, that's going to be worth 24 lakh rupees at that time because of education fee inflation. Despite all that, you end up with about 13 crores, as you can see here. So we'll be getting into all of that in just a bit. But broadly speaking, think about it, right? Whether you have a specific goal or whether you have multiple goals in mind, that becomes critical. And there are you can invest for both these goals using some things that we would be sharing. Here's an example, right? 30,000 rupee SIP starting at the age of 25 gives you the ability to do all these things. And at the same time, when you retire at the age of 60, you can still draw 55,000 inflation adjusted. So the actual money that you draw will be several lakhs, maybe 4 or 5 lakhs at that point in time. So that is how a full-fledged, wholesome financial plan looks like. And how this becomes possible, we will get into it right away. If 30,000 is too much for you, 20,000, again, here's what you can do with 20,000 rupees per month. And if you're 30, if you're investing 30,000, I took you through this example right now. Let's rewind though, because I first wanted to give you an idea as to what is possible with good financial planning, especially through these 3 tables here, where I told you having that SIP, how that can help you fulfill different goals while you're saving for the bigger goals in life, whether it's a home, whether it's retirement. But let's rewind and let's first look at what are SIPs. I'm going to share my once again. So quite simply put, SIPs are a method of investing. People complicate investing, people complicate what mutual funds, SIPs are, but quite simply, it is a method of investing, and it helps you with 3 main things: where to invest, how much to invest, and when to invest. Now, it seems simple. We'll be tackling all these questions as we go along. And here's a quick illustration as to how this looks like, right? Let's say you are investing 10,000 rupees per month, could be any amount. There are now mutual funds where you can invest with as low as 100 rupees per month, and the upper limit doesn't exist. You can invest whatever you want. Where are we investing? In a mutual fund. Let's say we are selecting the Navi Nifty 50 index fund. Whether this is the index fund you should be investing in, there is a specific in this masterclass to selecting different funds for short-term goals, for medium-term goals, for long-term goals. We'll be getting into that. But first, let's go through the basics. because I do understand that every time I speak to someone about investing, about mutual funds, about SIPs, it's almost assumed every single time that everyone knows the basics, but brushing it up makes sense. When I'm investing, third of every month. So let's go through this calendar, right? So January, February, March, third of every month you're investing. In April, though, third is a holiday. It's a Sunday. So your money gets invested on the fourth. So think about it. If there's a holiday, you just invest the money on the next day, and that keeps happening. In September, if you notice, there are 2 holidays, third and fourth. So instead, you invest money on the 5th of that month. All that's wonderful, but what is it that is really stopping you from investing? In the comments, can you tell me some of the fears that you currently have at the moment when it comes to investing? Can you all share what you're afraid of when it comes to investing, so that we'll address it right away? Tanvi, that says money loss. Anbu saying market risk. Harshil Chajed is saying, okay, suddenly so many comments came and I lost Harshil's comment. Sorry for that, Harshil. But if you really look at 2-3 broad strokes as to what you're afraid of when it comes to SIP investing or just investing in general, right? It is fear of losing money, right? Then there is no guarantee of returns in the stock market. So how does that play out? At the same time, can you really trust someone? Are they trying to fool you? Like even here, right now, this is absolutely as incentive less as it can come, this particular masterclass. But at the same time, you would have it at the back of your mind that maybe, is the knowledge that he's sharing actually trustworthy? We'll get into that because I'm going to share a few things with you. Lack of knowledge, big factor that always stops people from investing. So every time I speak to someone, I can boil down the main fears into 3 categories. The first one is I'm afraid of losing money, and if the market falls, the value of my money will go down. Someone's in the comments saying that they don't know which mutual fund to select. We'll be addressing that because next fear is I don't know where to invest. And finally, we have I don't understand numbers, and all this is very complicated. Investing is this one very strange thing that combines numbers in a way and emotions, 2 of the most misunderstood concepts as humans that we can entail to. So because it's at a crux, because it's somewhere in the middle, right? Think of it as a Venn diagram, and you have emotions, you have numbers, and investing at the intersection of all of that. So 3 biggest fears, how do we tackle them? First up, let's tackle I don't know where to invest. A lot of you shared that in the comments right now. Lack of awareness, Anna, you're saying, and don't know where to invest. So let's first tackle that, because once we tackle that, we are going to start really understanding what different assets work like. So I'm going to share my screen once again with you all. And I think that's going to take us to so can you all see this? Okay. So these are arbitrary numbers, right? We can just change them. Doesn't matter. Let's say you're 25 years old, doing a 10,000 rupee SIP. What happens if you invest in different categories? If you invest in a savings account, in an FD, in mutual funds, how does your money work? Now, the difference, if you notice in this highlighted section 5 years from now, is not too high, correct? With mutual funds, you have about 8.2 lakhs. The lowest amount in the savings account is about 6.48 lakhs. So a difference of about 1.5, 1.6. Meaningful difference, but won't really change your life. But look at what starts happening as you move along, right? 20 years from now, or even say 10 years from now, the difference between a 3% return, 7% return, and a 12% return really starts to work out. You have 17 lakhs in an FD, you have 23 lakhs in a mutual fund, and you have 14 lakhs in a savings account. Zoom out even further, and the difference just starts getting bigger and bigger and bigger. So if I can draw your attention to this particular graph here, you will quickly realize what starts happening as the years start rolling, right? You're starting off at 30, at 40, 50, 60, the difference just compounds. And as we saw in this particular sheet earlier, where you can have an SIP and still manage to pay for multiple things as you're living your life, saving for the long term goals, as this plays along, it's important to also keep in mind the longer term numbers. So let's say what happens 20 years from now, what happens 30 years from now. Very essential to keep that in mind. And clearly, if you notice, mutual funds here are the highest. And these are all historical numbers. This is not me making up stuff. In fact, the Indian stock market has actually done about 14% over the last 30 years. So if you're looking at that longer time frame, I don't even want to get into 14 because, again, at heart, I'm a pessimistic investor. I don't want to plan for the best. If something wonderful happens, I'll be more than happy with it. But this is a more realistic expectation from your mutual fund returns. So clearly, mutual funds are giving you the highest return. Then, in that case, why is there a fear in investing in them? Why do people get afraid when we think about or talk about mutual fund investing? Why don't many people do it more often? And that's because, look at this. This is how much the Indian market has dropped by every single year since its inception in 1979, which is crazy when you think about it, right? Every year, there have been only 3 instances or 4 instances in the past 44 years where the market has not dropped by 10%. Otherwise, every year it drops by 10%, which is absolutely mind boggling. And that is why people are afraid of investing, because it is extremely difficult to see the value of your money go down when it's hard-earned money. It's money that you need for something. And that is why investing is hard. That is why investing in mutual funds is difficult. And very shortly, that will tell you how you can go about managing the risk and managing just your portfolio overall. Right? There you go. Only 4 out of the past 44 years haven't had a 10% fall. This is what I was talking about. Scary chart. What this also tells you, though, is that when you're investing for any goal, you want to almost expect that the stock market is going to fall by at least 10% every year. If you notice, it has had more falls as well, right? Higher than 10%, more than 20%. Also, you see a lot of tall buildings here. Over 40% falls have also been there. 2020 COVID crash, we narrowly missed out on the 40% crash, but a 60% crash in 2008. Just imagine you've got 10 lakhs invested, 60% crash takes place, and now you're at 4 lakh rupees. That is scary, but there are ways to mitigate this. And to mitigate it, you truly have to understand what mutual funds are. So in the next 5 minutes, I'm going to quickly explain the idea of mutual fund investing to you, and then we will get into the details. 1 second, I think my screen is not getting shared anymore. Yeah, it's not getting shared. I'm going to share my tab. Give me 1 second. If you're finding this useful so far, type your most favorite emoji out in the comments. I'm just going to load my next screen. There you go. I can see a blue heart as well. Denver, you have got a cool looking duck. But what are mutual funds, right? Let's quickly understand them. I'm going to spend about 5 minutes at the most on this. But again, important to understand the basics before we start setting ourselves up for where to invest, what to do to potentially not have these big drops, right? 30%, 40%, every year 10%. What can we do about that? But before that, to understand mutual funds, I want you to think about Spotify for 1 second, right? Think about Spotify, YouTube Music, Savan, whichever music app you use. Each of these apps has a playlist. So look at all these Spotify playlists, right? You've got a classic Jab We Met playlist here, or Jab We Met era playlist here. Then you've got more new hits as well. I took this screenshot, I think, 3 months ago when I was doing something. So maybe these are not any more of the hot hits in Bollywood. But think of this, right? Every playlist is a collection of songs at the end of the day. And the collection of songs has a common theme. So, for example, if you look at All Out 2000s Hindi, you are not going to see a song that has come out in the past 2 years. You're not going to see a song by, say, Ed Sheeran in this particular playlist, correct? Or you're not going to have a classic 90s song, Main Koi Aisa Geet Gaun, or something like that in this playlist. This playlist is only having 2000s Hindi songs. That is it. So a playlist is a collection of songs and it has a theme to it. Think about it that way. Mutual funds are very, very similar. Mutual funds are also a collection of different investments. They could be stocks, bonds, gold, real estate. But think of a mutual fund as a playlist. And when you buy one mutual fund, you're buying that themed playlist of investments. And depending on the name of the mutual fund, you can tell what kind of a playlist it is. So, for example, here, if we look at All Out 2000 or a Hot Hits Hindi, it's a alliteration. If you look at that, it is very simple English language that tells you what that playlist is. But in mutual funds, because it can get complicated nomenclature, I wish it gets simpler. But because of that, it becomes difficult to tell where that mutual fund is investing money. But at its heart, a mutual fund is a collection of different investments, and you're buying a theme when you invest in a particular mutual fund. So how does it exactly work? Let's get into the details. So there are investors like you and me. We have money to invest, and we want to invest in stocks. So we can either directly invest in stocks, but we may not have the expertise, we may not have the time, we may not have, even if we have the time to invest, we are worried about at what point should I sell it. So we want to approach it in a more professional way. So with mutual funds, you give money to a mutual fund house and you have fund managers there. These are qualified people who have spent decades in the investing landscape. They are licensed to deal in investments. I'm getting a comment here from Kunal that says the video is getting stuck a lot in between. Is everyone facing that issue at the moment, or can you see me smoothly? If you can see me smoothly, give me a thumbs up. If you're not, then just let me know in the comments. I'm just going to hang on for 10 more seconds because by the time I say something and you hear it, there's a 10-second lag. Okay, superb. Seamless streaming. I am in my home office. My home is right upstairs. So you may hear a bell ring, my dog bark. We are on very, very strong internet. So I'm not worried about internet right now, but things happen. So if we drop off, we will be joining right back. So don't worry about it. There you go. All right. So most of you, apart from 1 or 2 comments, maybe I can pretty safely say that you all can see me pretty well. So here we go, right? So fund managers, typically a fund manager needs to go for multiple licenses. These licenses are given by all governing bodies in India. So you can rest assured that the fund manager, him or her, is very, very well qualified. And their entire job is to 24/7 just look at investment opportunities, look at what's happening in their portfolio. Whereas people like you and me, that is simply not possible. I consider myself to be a pretty on the top of things investor, someone who understands a little more than the average person. But even I don't invest directly in stocks. A very, very small amount of my net worth is directly in stocks. Otherwise, even I go through mutual funds because that just takes less headache and less time. If I spend the same amount of time that I do researching a stock on my work, I can just end up earning more money. If I earn more money, I just have more money to invest. That is where I come from. So fund managers, this is how it works. Investors, like when we give money to a mutual fund house, fund managers decide where to invest. And these are very large teams. Just for fun, I got two screenshots here from one is an Edelweiss mutual fund team. Just look at how many people they have. And this is a Parag Parikh team. Smaller team. I don't think the Edelweiss photo was from an offsite, and whereas the Parag Parikh photo was from a press conference they held. But big teams devoting all their time to figuring out where you can invest. So according to their analysis, according to their research, they take your money and they invest it in different categories. So for example, the stock market in this particular case. So do mutual funds invest only in stocks? Can you all tell me what you think? That is, if that's true, if that's not. Do mutual funds only invest in stocks? Is that true or false? All right. Most of you are saying no. Arpita, you're saying not sure. There's someone who's my doppelganger. His name is not doppelganger, my namesake. His name is Udayan. Okay, most of you agree that mutual funds do not invest in stocks. And someone actually commented saying it depends on the kind of playlist that you select, the theme. This is so accurate. Glad that you were with me during that entire analogy that I drew. Okay, mutual funds don't only invest in stocks. Before I start off and tell you more about how this works, I'm going to make a small request to you. We are currently doing this on YouTube. Our first long form video, something that we've put a lot of time and energy into, is coming up on Sunday. So tomorrow at 10 a.m., we're going to launch our first video. So if you can hit the subscribe button, that would mean the world to me. Thank you so much. Thank you so much. Thank you so much. Every one of you, almost I would say 99% of you got that right. Mutual funds don't only invest in stocks. They invest in possibly all kinds of things. So the common ones are gold, bonds. Mutual funds also invest in real estate. So think about it, right? Different categories, and mutual funds give you access to all these categories. Thank you so much. A lot of you are saying you've subscribed. Thank you so much. Means the world to me. Thank you so much. Thank you so much. If there's one comment that says, if I could reduce the chat requests. If you don't want to see the chat, there's a way to hide the chat. So keep that in mind. If you want to keep scrolling through, I don't want to limit the chats, because if there's some tech issue, if something else is happening, I want to know about it, and this is the only way I know. My wonderful editor Rishikesh is also backstage right now. I can see him, but it will take quite some time for him to reach out to me, because we are on airplane mode everywhere else. So yeah, hide the chat if it's becoming a hindrance. Here we go, right? So various kinds of categories, and all of these you can invest in through mutual funds. So first up, there are equity or stock mutual funds. You'll keep hearing the word equity from me. Equity essentially means the stock market in very layman's terms. So mutual funds that only invest in stocks, let's say Tata Motors, HDFC Bank, Bajaj Auto, Nestle, could be other stocks as well. I've just named 4 or 5 very big ones. Those are called equity mutual funds. Then at the same time, we have got 2 other kinds of categories that can also go into mutual funds. These are called multi-asset funds. They invest in different assets. So could be stocks, bonds, gold, could be a mixture of all of these, could be just a couple of categories in this case. And finally, you have bond or debt mutual funds. I realized the title here was not multi-asset, but here we have got bonds or debt funds. Now, it's very, very important to understand what bonds are, because as we go along, for shorter term goals that you have, right, whether it's 0 to 3 years, 3 to 6 years, when I share where you can invest for all these goals, it becomes very essential to understand what bonds are. So I'm going to spend a couple of minutes on that. I live in the city of Pune. A metro is getting constructed right across the road if I walk out. Now, the metro construction is a multi-thousand crore project. And this is happening all over India, right? Different projects may not also be a government-related project. Maybe, let's say, when let's say Jio now wants to enter a new space, Reliance Jio, and they need 5,000 crores or 20,000 crores, like a big amount for that project. They've got several options. They can go to a bank, they can ask the bank for money. What tends to happen though is banks lend to corporates at a slightly higher rate. So it's expensive to borrow money from a bank for most corporates. And secondly, the amount that could be needed is also significantly large. So banks may not be willing to give you that much money for a project. That's number one. Number two, they can otherwise come to people like you and me and other big institutions, and they can tell us that we want 1,000 crores or 10,000 crores for this project, and in return, we'll pay you a 7% annual interest, right? We want 10,000 crores, we'll pay you 7% annual interest. Now, this 10,000 crores is not coming from one person. It is coming from hundreds and thousands of people. Many large institutions are also giving this money to, say, Reliance Jio or NCC Urban or the state government, whoever is constructing that project or wants money for a project. Now, the benefit that you and I have of investing in a bond is that we tend to get a little higher interest than, say, a fixed deposit or a recurring deposit. And the benefit for the company that is floating the bond is that they get a slightly lower interest rate for their home loan, for their loan, sorry. And so it's a win-win on both cases, right? The company borrows money at a lower rate and we are getting a higher interest on our investments. So at the heart, that is what a bond is. And there are different categories of bonds. There are bonds that expire or mature in 1 year, 30 days, 1 day, 10 years, 5 years. And generally speaking, bonds that have a lower maturity are safer. Bond mechanics is an entirely different ballgame, gets very technical. I love talking about it, but we will reserve another masterclass for it, because let's focus on mutual funds and bond mutual funds and other categories of mutual funds. How many of you have wondered, while I've been talking about mutual funds so far and these categories, as to what an index fund is? Can you tell me in the comments if someone is very sure as to what index funds are? Once we set up this base, we're going to get right into how to select how to select mutual funds, which mutual funds to select, how to go about planning for various goals. We are right at the edge of finishing up with our setting up the base. So how many of you are very confident? Tell me in the comments what index funds are. I'm going to take a couple of moments to have some water. So a lot of you have been saying Nifty 50 in the comments. The other common answer is I have no idea. And don't worry about it. We're going to make it clear in the next 3 minutes. Aishwarya is saying portfolio designed to mimic the BSE or NSE. Someone is saying top 50 companies. People are saying India's top performing stocks. Someone is saying a mix of stocks and bonds. Angelina. All right, so let's get into what index funds are. I have a question for you as I answer that question. When I was sharing what mutual funds are earlier, who did I say picks stocks or investments that go into a mutual fund? If you can tell me that in the comments, that'll be super helpful. Who picks stocks that go into a mutual fund? Because how index funds function, they're very closely linked to who picks the stocks in mutual funds. Again, the most common answer here is a fund manager, right? That's what I shared. Experienced people, licensed people with a lot of years of experience, big teams, big budgets, researching stocks 24/7 to help find the best investments. Fund managers, that is right. Now, what happened in an index fund is that an index fund is not based on a fund manager's research. The fund manager, no matter how big their team is, They cannot say that we will invest in these 7 stocks. That does not happen in index funds. Instead, there is a pre-decided basket of stocks that is decided by exchanges like the National Stock Exchange, Bombay Stock Exchange. They decide on a group of stocks, whether it is 50 stocks, 30 stocks, 100 stocks. We'll get into the categories of that in just a bit. But the index fund, like a Spotify playlist, like a mutual fund, also has a theme. The theme is the common part, whether it's a normal mutual fund or an index fund. And the idea is that when you select, or when BSE or NSE, not the fund managers, when the BSE or NSE is selecting these stocks, they want it to represent one particular category of the Indian stock market. So think about it this way. Tell me in the comments if you have come across these headlines that say 11 lakh crores lost in the stock market today, or India's market down by 5%. Have you come across those very extravagant, bold headlines? When people are talking about that, when those headlines are being discussed, people are talking about India's broader index, which is the Sensex or the Nifty. Now, with the Sensex and the Nifty, we'll get into that as well in just a bit. But Nifty represents India's top 50 stocks. And by top 50, I mean in terms of size. So the 50 largest stocks. And they keep shuffling, so it's not a real-time 50 large stocks list. But these are the stocks that represent India as a whole, or represent the Indian market in the most accurate way. Whereas the Sensex represents India's top 30 stocks. So I want you to have that vision in mind, right? When think of a cake, okay, I'm going to use a different analogy. Think of a cake. Now, if you want to, and it's a layered cake, it has different flavors in it, and every layer has a different flavor. Now, if you cut the cake horizontally, you're going to get a cross section of that cake. And an index fund is like a cross section of the Indian stock market as a whole. So if the Indian Nifty 50 also increases, then there's a high likelihood that other parts of the Indian market are also increasing. That doesn't happen every time, but as a broader rule, things tend to move in sync over long periods of time. So keep that in mind as we go along. Nifty 50, India's top 50 stocks. Sensex, India's top 30 stocks. Here are the top 50 stocks. Here are the top 10 stocks in the Nifty 50. You've got HDFC Bank, which forms 11% of it. Then you have Reliance at 10.22. The two biggest constituents of the Nifty 50 are Reliance and HDFC Bank, forming about 1/5 of the Nifty 50. So if these two stocks perform well, there's a high likelihood that the Indian stock market would perform well. But at the same time, the other 80% also have to do well. But because they're the largest players, it becomes important to track their performance while looking at Nifty 50. So all these names are very familiar, right? HDFC Bank, Infosys, Larsen & Toubro, TCS, ITC, Axis Bank, State Bank of India. There are other kinds of indices in India as well. I shared the two most popular ones, Nifty 50 and the Sensex. Then there's something called as the Nifty Mid-Cap 100. So it invests in India's 100 to 200th stock in terms of size. If it's investing in that, then that's categorized as a mid-cap 100 stock. Then at the same time, you have 250 to 100, 500 stocks, so that's a small cap. That's the categorized as a small cap index. So what happens when you are investing 10,000 rupees in the Nifty 50 index? I'm getting a question here which becomes very important to address. Atish Nair is asking, why is there a weightage here? So Atish, I'm guessing you're talking about this particular table, right? So every few months, the National Stock Exchange, in this case for Nifty 50, because they're the ones who are deciding which stocks go into the Nifty 50, they decide how accurately certain stocks depict the Indian stock market. So the Nifty 50, the list of 50 stocks is not constantly the same. It keeps changing. Sometimes you will see stocks in the Nifty 50 index today that weren't there 3 years back, or stocks that are there today that won't be there 5 years later. In fact, there are very few stocks, if I've got the number right, less than 10 stocks that have been constantly in the Nifty 50 since its inception, since many decades. So, how frequently, I'm just looking at the comments once again. Yeah. So, the thing is, because the Nifty 50 stocks keep changing, if you're investing in a Nifty 50 index fund, you're automatically buying new stocks and selling different stocks. You just don't know about it because it's the indices job. It's happening at the indices level. Right? So what happens when you're investing 10,000 rupees in the Nifty 50 index fund? What actually happens? Out of the 10,000, 1,107 rupees goes towards HDFC Bank. 1,022 goes towards Reliance, 780, ICICI Bank, and so on. So essentially, when you're buying an index fund, you are indirectly owning HDFC Bank. The HDFC Bank stock price, last I checked, it was higher than 1,100. I think it's 1,500, 1,600. So if you had to go out today and buy an HDFC Bank stock, you'll at least need 1,500 to 1,600 rupees. Whereas through an index fund, even if you're investing 1,000 rupees, right, you're buying 100 rupees roughly worth of HDFC Bank stock. And this 10,000 rupees gets spread across these 50 stocks in the weightage that is prescribed by the National Stock Exchange. Now, this is a very broad understanding in terms of what happens actually on ground. Let's say the weightage of HDFC Bank is 11.07% today, but tomorrow HDFC Bank goes up. Its weightage will change slightly in the index. Ravi Shankar is saying in the comments, please share your tool and list of how to select a mutual funds. Yes, we are getting into that in the next few slides. We are getting into how you can invest, where you can invest, how to select various mutual funds for your investment goals. Yeah, Infosys spelling Ruchi spelled incorrectly. That's right. I'm sorry for that. So here we go, right? So we've been talking about first what SIPs are, what are mutual funds, but what are the real benefits of having an SIP? Have you thought about that? Is that a question that has come to your mind? Have you ever wondered why SIPs are always recommended as the go-to investing approach? Have you thought about it? Tell me below if you've thought about it. Several comments: consistency, low risk, greater exposure of the market, compound interest. If you really drill down, there are only two ways you can invest money, right? Through an SIP or as a one-time investment. There are other ways too, we'll get into that, but broadly speaking, two ways. Where you can invest in one go, or you can break that investment down into multiple chunks. This is the Indian stock market over the years. Right? Since 2007, you notice how it has gone up, down, it is like a wave, but the trend is upwards. So back in 2007, 2006, Sensex was at 4,000. Today it's at 22,000, 5x growth. If you had bought at lows, you had bought Sensex at 3,000. Now it's at 22,000, 8x growth. Have you noticed what would happen if you invest at these particular points? Have you thought about it? How many of you have actually invested when the market was high? The moment you invested, the market started following. How many of you have been at the receiving end of that? where you invested and you started losing money. This is the Nifty. Sorry, this is the Nifty, not the Sensex. My apologies. This is the Nifty. There you go. How many of you started investing and the market started falling? Mohit says it happened to him in cryptos. Chances are the highest. So I'm getting a very interesting question in the comments, and I'm just going to go back a couple of slides so that we understand that question. The question was, if the Sensex or the Nifty was a playlist, then how come these numbers are getting attached to it? 4,000, 2,000, 22,000. So when I said in the previous chart that Nifty was at 22,000, superb question. How does that 22,000 come about? Right? So let's say Reliance here, right, is about 10.22%. Out of the 100% that Nifty is, 10% roughly is Reliance. So now today, if the Reliance stock goes up by 10%, that means by itself, Reliance has contributed a 1% gain to the Nifty in this case. So when all these stocks move up and down, they're contributing in their own way either to the growth of the index or the falling of the index. So the overall return that you get is like an average of all these up and down movements. Does that make sense? If that helped you out, type out again your favorite emoji in the comments box. Right, so two broad ways to invest: through an SIP, through lump sum. Now here's what happens, right? If you invested at peaks as a lump sum investment, then you are at the risk of investing money and the value of that money really dropping fast. I've got various instances of the biggest drops in the Indian stock market since its inception in 1979. So this is a Sensex. In 86, when there was a drop, it fell by 40%, over 40%. So think about it. You invested, let's say, 10,000 rupees, and then the market just keeps falling. It keeps falling. It keeps falling. And eventually it fell by over 40%. And it took 2 years and 4 months for the market to go to the previous value where you had invested at 659. And it's happened very, very frequently, if you notice, right? Over 40 years, 8 times or once every 5 years, there is a big drop on average that happens. The last drop that was massive in stature was the COVID 2020 crash. The market was at a high on 14th Jan 2020, 41,900. It fell by 38-39% at that point. The recovery was the quickest. So in 10 months, the market went back to 41,952. So if you're investing at these points when the markets are dropping, there's a chance that by the time you get back to the point where you're invested, it's been several months, or in some cases, if you notice, several years. The 2008 crash was one of the most nasty ones for two reasons. First up, the market fell by over 60%. And secondly, it took a while for the market to go back to the price it was, right? Look at this. These are Sensex values here. This is Nifty, but again, they would be in sync, right? So look at this. If you invested here, how long would it take for you to get back to the original amount? Keep this in mind, right? This final example, 14th Jan, the last crash that we potentially, all of us, were either a part of the market, we had invested money, or we heard about other people talk about it, that my investments are down 30%, 20%, 50%. So think about this. 14th Jan you invested, your investment would have dropped by 38% as the lowest, and it would have taken 10 months for you to have zero loss, zero profit on that investment. On the other hand, if you had an SIP investment going into the same index, right, that would have grown by 36,000. And that is because you are buying at all these points. As the market falls, you buy. As the market is at its bottom, you buy. As the market increases, you buy. Because what is an SIP, right? It's a method to invest money. You schedule your investments. So no matter what is happening in the market, every single month on that date, like clockwork, your money gets invested. So because of that, no matter if the market is down 30-40%, you buy at that price. So when the market again starts going up, that investment that you had bought when the market was 30-40% down, that is going to be significantly up. That is the magic of SIPs. At the same period, the same 12-month period, lump sum investment would have done zero returns. Your SIP investment has grown 36,000. You may say that what if I invested here at the bottom? Correct? Is that a question that crossed your mind? Is that a question that crossed your mind? A lot of you saying yes in the comments. Now tell me one thing, honestly, when the market is down 38%, when the market is down 25%, when everyone is absolutely losing their minds, the world is facing a crisis that it has never seen before in COVID, would you have the courage to invest a large amount of money in one go? Some people do and they get rewarded. But would you have the courage? Most people don't. If you have the courage, go for it. There's a beautiful Warren Buffett quote that goes something like, only when the tide goes out do you realize who was swimming naked. So when something does not work is when you realize what the faults with it were. And that's very, very true with investing. Someone asked me in the comments, how do you know if the market is going up or down? Nobody knows. Nobody knows what's going to happen in the market. People who do know what's going to happen, people who do tell you what's going to happen in the market, they don't, they're lying, or they're trying to sell you something, because by them claiming to know that they know something, they seem to have superior knowledge. Truth is, nobody knows, right? And the challenge with, say, trying to invest at these bottoms is that you always feel that the market's going to fall much more. So you wonder, okay, it's down 20%. Can I wait for 10 more days? Will it be down more? Can I wait for 3 more months? So you always try to predict the bottom, and no one can predict the bottom. So in that case, an SIP investment would have grown by a significant amount. So there you go, right? This is a summary of it. 1.2 lakhs invested in Jan 2020 would have dropped to 75,000 in March 2020 and still been at 1.2 lakhs in December 2020. Whereas an investment here would have grown to 1.56 lakhs in an SIP. So SIPs, if you think about it, they reduce entry risk. That's one of their biggest advantages. One of the big fears that we had was, I don't want to lose money while investing. And SIPs, in a way, are a method and a tool for you to potentially reduce the odds of you losing money. What else can you do to not lose money? Who wants to know the answer to this? Who wants to know how can you not lose money while investing or significantly reduce your losses? Who wants to know? Abhinav has made a comment here. He says, basically our SIP returns will be an average of the fall and the high of a market. And hence, that will save us from the unexpected bad and good returns. That is true. In an SIP, you're buying when the market is high, you're buying when the market is low, and when the market has gone to sleep, the market is just not moving. Even during that time, you're buying SIPs. And because of that, because you've bought it at different prices, when there is an up move, you get the benefit of it. If there's a down move, you again get the benefit of it because you're again buying during the downturn. Correct? Divya says, who wouldn't want to know how not to lose money? That is very true. So here we go, right? First is expand your time horizon. When you're investing, if you have a 1 day period where you want to invest in the stock market, you essentially have 50% odds of losing or making money. It's a coin toss. You shouldn't play games where the odds are 50-50%. Never ever, right? Likhit, I see you've asked me this question a couple of times. I'm going to get into it. You asked me where to park. Emergency fund, so many options, liquid funds, debt funds. In about, I think, 5 to 10 more minutes, we're going to get into fund selection and how to invest for various goals, whether it's short-term goals, emergency fund, whether it is you want to buy a new phone, you want to save for your marriage, medium-term goals, where you're not really sure when that would happen, but you still want to invest, and also long-term goals, where you just want to keep investing for a goal that's very far away. We're going to get into that in just a bit. Gina is asking me, can I invest? Is that 5 lakhs in one go or should I do it monthly? Very good question. I'm going to answer that right at the end because we have to understand everything before we get into it. So far, is there any question, any query, anything that you want me to go over once again? If I get a lot of you saying the same thing, I'm going to go through it once again. Otherwise, I'm going to move on to how can you not lose money apart from expanding your time horizon. Okay, different questions. So I'm not going to answer each and every one right now. At the end of the session, I'm going to talk to you guys for a long time. If you have questions, that is. Otherwise, we'll say goodbye at some point. But moving back to this, right? Moving back to how to not lose money, the first point is expand your time horizon. Now that becomes very crucial because what if you can enjoy high returns and when the market falls by 40%, what if you only fall by 15%? So within COVID, the market was down 38%. Could there have been a chance that your portfolio did not fall by as much? And at the same time, you were getting the good high returns. Here's something that I want to share with you. So if 100% of your money is invested in the Nifty 50 index, which is equity, right? I keep using that word. I shared what that is. It means stocks. So if you're investing in the Nifty 50 index, your 20-year annual returns would have been 15%, 15-year annual returns 16%, 10-year annual returns 14%. Maximum fall of 59%. This is during the 2008 crash. Now, here's where it starts to get really interesting. If you add 30% bonds to your portfolio, look at how much the maximum fall goes down to, from about 60% to 40%. And your return over a long period has only dropped by 1%. So think about this. You had 10 lakhs invested in an all equity portfolio. That would have gone down to 4 lakhs as the lowest point. In a portfolio that has 30% debt or bonds, that would have gone down to 6 lakhs. So instead of 4 lakhs as the lowest point, the lowest points with bonds would have been 40%. The more bonds you add, the lower your falls. Your returns also decrease. Keep that in mind. So if you look at, say, 15-year returns across or 20-year returns across this time frame, your returns also increase. But they don't reduce by a drastically large amount if you think about it. And one of the concerns, the biggest concerns that even all of you shared with me, I had it on my slide, was that you're afraid of losing your money or the value of your money falling down. So what if you can get 10% returns? What if you can get 12% returns and reduce your maximum falls by 80%, by 60%? That's going to help you just stay invested When the markets start crashing, you're not going to be the one selling because your portfolio hasn't crashed by 60%, 50%. So here's a thought to have. Here's something that should be considered. I am of a very strong opinion that no matter who you are, unless you're an investing genius and wizard and can just keep investing, have a 20-30% bond element to your portfolio, a safe element to your portfolio, because that just helps you feel better about money when the markets are crashing, because your portfolio wouldn't fall by as much. In almost every client portfolio that we work with, there is a safe element. It could be 5%, 10%, 20% higher in some cases. But having that small one, having that small element can really help you stay invested, which is very, very crucial. If you invested a one-time amount, here are the odds of losing money in the Indian stock market. This is the Nifty 50 index once again. If you had invested in the Nifty 50 over 5 years, you would have lost money only 0.1% of the time. Once again, expand your time horizon, right? If you're buying and selling every single day, almost 50% odds of losing. I don't like to play games where the odds of losing are more than 10%, because you have to live one more day to fight that battle. If you're down in the first day, if you're down in the first year, how are you going to live that? How are you going to live to enjoy those gains in the future? So anytime you're investing in the stock market directly or completely 100%, keep this number in mind. Keep the number of 6 years in mind, 7 years in mind. Because historically, if you have stayed invested for that long, you haven't lost money. And all of this information becomes relevant to fund selection, because where you invest money, and the reason I've set up this foundation is because you have to truly understand why those categories of funds are required for a particular investment goal or time horizon. So keep that in mind, right? With respect to your lump sum investment, at least 6 to 7 years. I'm going to stop sharing screen just for a second. I'm going to share the entire screen with you to give you. Just give me 1 second. Okay. Can you see the screen? So this is an SIP metrics. So like here, I've given you after what point you wouldn't lose money through a one-time lump sum investment, which is about 6 years or 7 years specifically. In an SIP, how long in the past would you have to stay invested for you to make positive returns? This is very complicated. This table seems like it's actually straightforward. Let me take you through it, right? Look at this. Over any 20-year period, since July 1999, over any 20 years, right? July 1999 to July 2019, July 2000 to July 2020, your SIP returns would have been a minimum of 13% per year annualized, maximum of 15%. I put up a reel on this, I think just last week. Wanted to really, I think this itself, the concept of this, if we really get into it, is an entire different masterclass. But over this long time frame, 13 to 15% is the range of returns. If you start decreasing the time frame, you start seeing smaller, lower returns, correct? 9%, 8%. At what point would you not have lost money? So if you notice, over 3 years, there is one instance of you getting minus 8% returns, but over 4 years, there is zero. The lowest returns you'd have gotten are 0%. So for you to get positive returns in SIP investing, again, have that 5 to 6 year window in mind. If you're investing in equities, if you're investing in stocks, that becomes very crucial. Just having that in place, right? So for lump sum investing, 5 to 6 years or 6 to 7 years. For SIP investing, 5 to 6 years. Keep that in mind. Were you able to see the metrics when I was sharing that? There's one comment that said that you couldn't. You were. Okay. Superb. So I'm going to share my screen once again. So as we get into fund selection, how to go about it, where to invest for various goals, there are 4 learnings I want you to keep in mind. Firstly, do not invest in stocks or equity mutual funds for the short term. We saw what short term was, between 6 and 7 years. So keep that in mind, that golden number of 6 years, keep that in mind. So think 7 years plus when you're investing in stocks or equities. For shorter term goals, you want to have bonds in your portfolio, because we saw how bonds and equities together they behave. So we want to have those in the portfolio when we're investing for anything short term. Lastly, this becomes very, very important. No one really talks about it. If you're afraid of investing, do not invest 100% of your money in the stock market. Do not invest 100% of your money even in a Nifty 50 index fund. That is where a combination, a portfolio approach comes in. That is where you select 3 or 4 funds, and within that 2 funds are very, very safe funds. Which these funds are, we are getting into it right now. Right, so who's excited for this section? Who is here for this section? Where should you invest? Which mutual fund should you select? And how to go about it? A lot of yeses. I see a victory emoji as well, a trophy emoji. There's one question that I keep seeing from Prasanna. How much of your monthly income should you invest? Again, Prasanna, we'll get into it right at the end in the question and answer round. But here we go, right? So where to invest, which mutual funds to select, how to go about it. I'm going to share a master grid of investing with you. So I'm just going to stop sharing this screen for a couple of seconds. Here we go. Let me just share that tab with you. It'll be easier to navigate. Okay, here we go. If you can see the text clearly, give me a thumbs up. If you want me to increase, let me know. Okay, a couple of you are saying it's not visible, so let me zoom in a bit. Can you see this? Okay, let me zoom in properly. 1 second. There we go. I'm just trying to increase the font a bit so I don't have to zoom in too much. Okay. I think I'll have to increase this. Okay. Here we go, right? So where you invest essentially is dictated by how long you want to stay invested for. So if it is a very short term goal, and by short term I mean 0 to 3 years, then you don't want to invest in the stock market, simply because you saw that in the short term, under 5 years, in the past there have been instances where people have ended up losing money and the markets have returned a negative return. So you don't want to be in a place where you need that money in a year, whether this is an emergency fund, whether it's for any goal. You don't want to be in a position where you've invested a lakh for a particular goal, but now that lakh is 60,000 rupees or 90,000 rupees. And for what you were saving for, you can no longer do that because you have lesser money. So you don't want to do that. So the two options that you have for short-term goals are arbitrage funds and bond funds. Now, who should select arbitrage funds? There was a change in how mutual funds are taxed from 1st April 2023. Before that, arbitrage funds weren't as popular. In the past 18 months or 2 years, they've become, or the past year, they've become supremely popular. So who should invest in arbitrage funds? Anyone who is in the 20% tax bracket. So if your income tax percentage is about 20%, invest in arbitrage funds. The reason for that is because the gains that you make in an arbitrage fund are taxed at 15% of the gains if you withdraw that money in 1 year. If you withdraw it after 1 year, you can end up paying zero tax because for the first lakh, it's tax free because it's categorized technically as an equity fund. And then if you've had gains of more than 1 lakh that you are booking or that you are selling. So I give an example of this, right? To just make this simpler. Let's say you're investing 1 lakh rupees in an arbitrage fund that has grown to 1 lakh 8,000 rupees. 8,000 rupees is the gain. If you sell it within 365 days of investing, then there'll be a 15% tax on that 8,000, which is 1,200 rupees. So your after tax gains are 6,800 or 6.8%. At the same time, if you're investing in a bond fund, which also grew at 8%, and you are in the 30% tax bracket, then that 8,000 is going to get taxed at 30%. So 2,400 rupees is what you'll have to pay in taxes. So in an arbitrage fund, your post-tax gain is 6.8%, whereas in a bond mutual fund, that can go down to under 6%. So keep that in mind. If your income is under 7 lakhs, anyway, you're not going to be taxed. So you can just, I'm just looking at this, looking at the comments for a second. Okay. I thought it wasn't visible, but can you now see the screen properly? Can you see the font properly? Do you want me to increase it still? Can you let me know that? If you can see it, say yes in the comments. It's perfect. All right. Great. Superb. A lot of you are asking me what arbitrage funds are, and we'll get into all these other categories of investing as well. So let me share what arbitrage funds are and how they work. Arbitrage essentially means you are playing between the price points in different markets. Forget the stock market for a second. In an arbitrage fund or in arbitrage generally, let's say you have to go buy an apple. One apple, it costs 100 rupees in your local store. Whereas if you go 5 kilometers away, it costs 90 rupees. So what you can do is you can buy the apple for 90 rupees and sell it in your local store. And you can make a profit of 10 rupees in the process. Similarly, in arbitrage funds, different fund managers, they're playing between the price changes between multiple markets, between different exchanges, between the futures and options market and the cash market. These are all technical terms for those of you who are not familiar with it. But think of it as fund managers enter that position when they know that there's a price difference. And only when there's a price difference does that investment happen. So it is safe because that investment only happens when there is a certainty of profit. Very small price changes, 90 and 100 rupees is a big price difference, right, of 10 rupees. In arbitrage, in the stock market, in such funds, the price difference is a few percentage points. So keep that in mind. Then for 3 to 6 years, we have hybrid funds. These hybrid funds are funds that invest in bonds. Okay, I realized I wasn't sharing screen. 1 second. Let me share screen once again. There's a question in the comments. Should we use arbitrage funds or bonds for emergency funds? If your income is under 7 lakh rupees, use bond funds. If your income is in the, I would say, even if you're not very sure about tax planning, even if it's in the 10-15% bracket, that is about 7.5 lakhs, then invest in arbitrage funds. If it's lower than 7 lakhs, bond funds. That's how you go about it. For goals that are between 3 and 6 years, right, it's a very odd window because it's not very long term, it's not very short term, somewhere in the middle. How do you go about investing in such short term, for such short term or medium term goals? You buy both bonds and stocks together, and you do this through a hybrid fund. Which these funds are, we're going to get into it in just a bit as soon as we are done with this particular sheet. And finally, for 6+ year goals, you have the option of investing in Nifty 50 index funds. These are funds that invest, as we have discussed already, funds that invest 100% of their money in the stock market. So keep that in mind. And let's now, for reference, I've just shared what the past 1 year returns have been. This does not mean that these returns are guaranteed or fixed. In arbitrage funds, these returns have hovered between 6.5 and 7% over a longer period. And with bond funds now, they've also been about 6 to 7, 7.5, 8%, depending on the bond you're investing in. But after taxes, if you're above 7.5 lakh rupees in income, arbitrage funds will give you better post-tax returns. So there you go, right? I'm going to stop sharing this screen, get back to fund selection. 1 second. There we go. Just give me 1 second. I'm going to toggle between screens as we go along. Okay. Can you see my screen once again? It's a checklist for index fund goals. For index funds, for goals that are over 6 years away. What do you need to keep in mind? First up, remember that for long-term goals, ideally you should have equities or stocks, and that is where index funds come in. The few things that you need to be aware of are, one is expense ratio. So you remember how in an index, in a normal mutual fund, the fund manager, based on their research, they were the ones who selected which funds. Now, as you can imagine, the effort it takes for a fund manager to select funds is significantly more than just following the index and its constituents. So 11% in HDFC, okay, invest 11% there. 10% in Reliance, invest 10% there. The fund manager, the only job is to, in an index fund, to mimic the index. They're not taking decisions as to whether to invest in Reliance, how much to invest. Those are decisions that are already made because it's mimicking an index. So the money that is charged as a fee to you when you invest in an index fund is very low, because the effort and time and resources it takes to mimic a fund is significantly lower. That's number one. So expense ratio should be as low as possible. In fact, let me share something with you. I hadn't planned on sharing this, but I can quickly just bring it up. Just give me 1 second. I'm going to be sharing with you two different funds. One is the UTI Nifty 50 index fund and its expense ratio and how much fees it charges you, and UTI's large cap fund, which is not an index fund, where the fund manager actively chooses funds. So here we go. I'm going to share this with you. Stay with me for 1 second. I thought this would be an interesting way to go about it. Here we go. right? So this is the UTI Nifty 50 index fund. As you can see, look at the expense ratio, 0.41%. So every year, out of 1 lakh, they'll charge you 0.4% as fees. So if you're investing 1 lakh, 400 rupees is the fees. In a large cap fund, which is actively managed, where fund managers are actively choosing where to invest, the fee is 1.75%. So if you're investing 1 lakhs, 1,750 rupees is going as fees. So because in an index fund, the effort is lower, resources are lower, the fee is much lesser. So keep that in mind, and I'm going to get into this once again. Right? So the first thing is the expense ratio should be as low as possible. Then we have the tracking error, where the tracking error, once again, think of it as when it comes to actually investing. 1 second. So sorry for this. 1 second. I'm going to share the right screen. There we go. So the second thing you need to be aware of is tracking error. Now think of tracking error as if, as we saw, Reliance is 10.22% in the index today. Actively, when the fund is getting managed and when the fund is getting new money to invest, it may not be able to absolutely invest 10.22% in Reliance every single time, or in other stocks as well. I'm using Reliance as an example. So while that money is getting invested, there is a small error that happens where instead of 10.22, 10.25 could get invested, or 10.10 could get invested. So because it's not a one-to-one investment each and every single time, it becomes uh, difficult for that index fund to give the same returns as the actual index. So if Nifty 50 has gone up by 10%, and if there is small, minute non-alignment, right, with respect to not 10.22% gets invested every time in Reliance, because of that, there's a minor difference. So if Nifty index is giving 10%, Nifty index fund might give 9.7%, because it takes time, it takes a lot of money moving to get that allocation right. So that is tracking error if there is a difference between the returns of the actual index and the index fund. So two important points to keep in mind. And finally, we have, while selecting an index fund, it should have at least 1,000 crores and it should be 2 years old. This is because the index that way then has a very good track record, and you don't really have to worry about whether the fund has enough reputation to do a decent job with it. So here we go. So the most important points: tracking error and expense ratio. This is an example. If the expense ratio is 0.5%, if the tracking error is 0.5%, if the index grows at 10%, your actual return will be 9%, because this will eat into 1% of your returns. So those are the two important points. Ideally, expense ratio and tracking error should be as close to zero as possible. Now I'm going to share the index fund selection guide with you all. So here we go. Just give me 1 second. I'm going to share my entire screen properly. Here we go. So these are actual index funds that I am going to be sharing. Okay, so can you see this properly? If you can see the screen properly, give me a thumbs up. All these tools, right, that I'm sharing, I will be sharing them with you later on. Am I lagging? There are a few comments that are mentioning that am I lagging? Or can you see me properly? Superb. I think the tech part is going well. So this is what I did, right? With respect to index funds, look at all these Nifty 50 index funds offered by various companies. Uh, it's ticking off this box where we have more than 1,000 crores invested in them. This is the expense ratio that is charged by all these index funds. So, kick the camera accidentally, sorry. So, this is the expense ratio charged. So, with respect to, say, Bandhan Mutual Funds, Nifty 50 Index Fund, the expense ratio is 0.1%. So, that means that every time you're investing, let's say, 1 lakh rupees in Bandhan's mutual fund, 100 rupees gets invested in the 100 rupees is charged as fees. So keep that in mind. And then we have the tracking error here. And what I have as a custom column is tracking error. So TER plus total expense ratio, right? The addition of this should be as low as possible, because think about it, expense ratio and tracking error both need to be as close to zero as possible. So which index funds have the lowest tracking error and total expense ratio? So you can sort this when I share this sheet with you as per the TER plus error number. The lowest one essentially becomes the most efficient Nifty 50 index fund. In this case, the most efficient is Navi's Nifty 50 index fund. Has over 1,000 crores, lowest tracking error plus expense ratio in India today. And I have been keeping an eye out on this fund. It has been the lowest since the fund started, which is about 34 months ago. Now, here's the thing, right? Does it really matter in absolute terms as to which index fund you select in out of all of this? There's a high difference, right? 0.11%, 0.25% between the total expense ratio and tracking error. So does it matter? So 1 lakh invested 1 year ago, these are actual returns that these funds have generated. 1 lakh invested 1 year ago would have looked like 1.28 lakhs, 200 rupees, and the lowest would have been 128, 109. So if you think about it, the difference between the highest and the lowest, right, is 160 rupees. That is it, which is less than 1%, or rather 0.1% of how much money you have invested. So while it becomes important to look at total expense ratio and error, and you could just very well go ahead and invest in a Nifty 50 index fund offered by, say, one of these three. Even if you're investing in, say, a different index fund, it's not as if your returns are going to be magnificently different. And that becomes very crucial to understand, because a lot of people, a lot of creators, they keep harping on expense ratio, tracking error, and how you should never select funds with high expense ratios. In an index fund, if you just follow the guidelines that we have in place of 24 months, 1,000 crores, then you're essentially good to go. Now, from where have I got this data, right? Because if you want to, say, do this on your own, how can you go about doing it? I'm going to share my screen once again and share a different tab with you. So here we go. Can you see this? So this is tickertape.in. Essentially, they have got various ways in which you can screen stocks or mutual funds and other investments. Just give me 1 second. The page isn't loading, so we may come back to it in just a bit. We will come back to ticker tape. We will come back to ticker tape in just a second. We'll come back to it right at the end. Maybe there's some server issue at ticker tape's end. Let's go back to the selection guide. Correct? So here you go. So these are the index funds that you can consider for your long-term goals. Keep in mind, every time you invest in them, expect the value of your investments to drop by that 10% every time, every year. Because a lot of people, they're surprised when their investments in mutual funds start dropping, but it's just uh, unrealistic to not expect the market to go down when you're investing in it. Uh, Joy is saying we need a class on elaborating bonds and debt funds. Yes, we do. Definitely, that's something that's on the cards. Also, for with these index funds, they're investing in India's 50 top stocks. What if you want to invest in other stocks, right? Smaller stocks, medium-sized stocks. You can also use index funds. You can also use actively managed funds. But the moment we get into fund selection for mid cap and small cap, especially, that itself requires, in my opinion, at least 1 hour of time to do justice to it. So we are not going to get into that today, but we will do that in the future. So yeah, these are the index funds to consider. Uh, I have money myself in, I think, the UTI and the Navi index fund. UTI, if you notice, is the biggest index fund in terms of the money that it manages, 15,000 crores, followed by HDFC, whereas Nippon, Bandhan, and Navi are relatively smaller in the realm, but 1,000 crores is still a lot of money. So keep that in mind. I'll be sharing this with you, and you can go through it. You can tweak around values. Let's now move on to where you can invest for other goals that you may have, right? That are not 6+ years away. As you can see, we have different categories right here at the bottom, different sheets. We'll get into that. But first, let's understand a couple of aspects with regards to how they work. So what are the goals that all of you have for the next 0 to 3 years? Can you type them out in the comments? What do you want to do with your money in the next 3 years? Go for a vacation. Pallavi says buy a house, is buying a car. Akash wants to do it all. He wants to go for a vacation. He wants to buy a car and a house. Nikita wants to go for a master. Superb. So as you can imagine, all these items, they are very important things, right? That you want to save money for, and you have a specific number in mind as to the amount that you want to build towards. So it becomes essential to not be in a place, as I shared earlier, where you invest money and when you need it, the value of that money has gone down. So the most important factor when it comes to investing for short-term goals is it should be safe, it should be liquid, and you should also worry about taxes while doing it. So as I shared earlier, if you are in a high category of taxes, arbitrage funds are the way to go. And by high, I mean 7.5 lakhs and above in terms of annual income. So I love, by the way, seeing all these short-term goals, such a diverse range, but these are all things that we care about. Right? Daughter's education, for example, or you want to buy a car. A first car is always a milestone event in your life. So if you want money for that, you never want to be in a place where you have lesser than what you need. So safety, liquidity, and finally taxation. So in that case, what are the funds that you can consider today? I'm going to share screen once again with you of the tool. You'll be getting this tool at the end. So don't worry about screenshotting and things like that. If you want to take a screenshot, go ahead. But these are some things that we would be looking at, right? So for arbitrage funds, we want to make sure that the AUM, asset under management, is over 10,000 crores, because I can't help but point this out. Vinita wants to buy a solitaire diamond ring. I'm guessing it's an engagement ring. So congratulations. But yeah, you don't want to invest in arbitrage funds, coming back to them, that are small in size. because a larger arbitrage funds gives more ammunition to the arbitrage funds to do what it needs to do. So that is one filtering criteria. Secondly, we want to invest in arbitrage funds that are at least 5 years old, because the entire idea of cost arbitrage, if a fund house has experience in it, then they are more likely to do a good job with it. Now, having said that, how then can you rate these arbitrage funds, right? My favored ones are Kotak and SBI, predominantly because of their very high AUM of 40,000 crores, 27,000 crores. Just 5-6 days back, I was on NDTV Profit talking about hybrid funds and arbitrage funds, and those are the two funds that I even spoke about there. So, but if you want to select something else, then how can you go about it? The best way, in my opinion, is once you have the 10,000 crore criteria in place, once you have the 5-year-old criteria in place, just look at rolling returns. So Invesco Arbitrage India, for example, has done 5.81%. Post taxes, this could be 5.3%, 5.4%. So again, compare that to, say, a bond fund, where in a bond fund, one question that you may have when I speak about bond funds is that isn't 5.8% too low, right? Because if you say compare it to an FD or an RD, that would give you 7%. The challenge with that is, on that 7%, you'll have to pay tax on the gains you make. And after the taxation rule change, anyway, FD, RD taxation hasn't changed. Bond funds taxation has changed. But even for an FD, for example, that pays you 7% interest, we'll do the math. You've invested 1 lakh in an FD for a 1-year goal. That has become 1,07,000. 7,000 is the gain. You're in the 30% tax bracket. So then you end up paying 2.1 to 2.3 thousand rupees in taxes. So your gains from 7% drop to 4.6, 4.9%, somewhere in the middle of that. Whereas in an arbitrage fund, you get that 0.5%, 0.7% more. If you look at the average returns, right? One more thing to keep in mind is that arbitrage funds kind of, even though the 3-year rolling return has been 5.8%, let's say for Invesco India, its 1-year return has been 8.38%. So in the past 1 year, arbitrage funds have done very well, and there is no chance of loss when you're investing in an arbitrage fund. That's why they become a wonderful vehicle. I have moved my emergency fund money into an arbitrage fund. We've been doing that for our clients of late as well. A lot of you know of Parag Parekh as the star fund, right, in India, and how they manage their money. Rajiv Thakkar, who is the brains behind Parag Parekh right now, he recently revealed that he's moved all his emergency money into arbitrage funds. So this is where it starts getting interesting. I would invite you to think about also moving your money there. So there you go, right? So 1-year return has been about 8.3%, which is wonderful. So as FD rates have gone up, arbitrage fund rates have also gone up, because if you notice, over 3 years, FD rates weren't always at 7%. They've increased in the past 2 years. At the bottom, right after COVID, I think it had bottomed at about 5.5, 5.6% FD rates. So again, keeping that in mind, arbitrage funds, because of the tax advantage, make absolute sense. And if you look at rolling returns, then maybe these are the 3 funds that you can consider. Parking your emergency fund money in, parking your short-term money in. And over a long period of time, if you notice, arbitrage funds have done between 6.2 to 6.7 odd percent. This is a 10-year return that you can see here. So one more point that I would like to specifically highlight when I'm talking about short-term money and where you can save it. If you look at the difference between, say, the returns of an arbitrage fund and a fixed deposit, post taxes, you are between 0.5 to 1%. Now, 1% over 10 years, 15 years, 20 years can be a significant amount. Yes, I agree with that. But when you're investing for the short term, at times you don't want that headache of figuring out where to invest. So if you're comfortable with a fixed deposit, and if you're okay that you have to break the fixed deposit, right? Because fixed deposits that way are kind of inconvenient. But if that's going to give you peace of mind, that is the way to go about investing. Don't think too much about maximizing, optimizing that 0.5%, 1%. I feel very strongly about that. Uh, Anytime I put up a reel about index funds and I say that uh, investing is more important in that index fund. As you saw, the return difference wasn't too much. And someone says, but what about tracking error? What about expense ratio? You haven't even spoken about it. Great things to look at. But the first thing is to start investing and get your money invested. So, so there you have it. You have these funds that you want to consider for your short-term goals. And finally, we move on to uh, uh, the medium term goals and how they fare against, and what funds that what funds we should consider. A lot of questions in the chat box. I know I have maybe answered one or two so far. We'll be answering all questions right at the end. This selection tool will be yours, along with the other tools that I'm going to be sharing. Even the step up SIP goal tool that we had, where you enter a goal, where you enter the goal, you enter how much amount, enter inflation, and it tells you how much money you need, how much SIP you would need for that. All of that will be yours. I'll be sharing it. So keep that in mind. And one request I have for all of you is that we are currently hosting this on YouTube, and our first long form video, I'm super excited about it, is going to go live tomorrow at 10 a.m. Thrilled. We are doing something different. It's not just me talking to the camera and sharing personal finance insights with you. So hit the subscribe button if you want to get that video in your feed tomorrow. It would mean the world to me. We are really putting up, we're putting in over the last couple of months, we've been putting in a lot of time and resources into long form YouTube videos, and the first one goes live tomorrow. So remember to subscribe. I'll truly sound like a YouTuber when I say hit the bell icon as well, but go ahead and do that. So would be wonderful if you can do that for me. Finally, let's get on to the last segment, which is how to invest for medium term goals, 3 to 6 years. I'm getting one question constantly before I get to that, which is NRI investing. With NRI investing, the way it works is, if you're an NRI in the US or Canada, then you have access to a limited number of fund houses because of because of anti-money laundering laws. For any kind of another NRI who's not from the US or Canada, you can invest in any Indian mutual fund. The only thing that you need to be careful of is you need an NRI KYC. So, and it requires a wet signature. So the next time you're in India, as per the KYC laws, you need to be present in India as well. So next time you're in India, get that NRI KYC in place, and you can start investing. So there you have it. We had a 2-hour window for this session. We're at 1 hour 53 minutes. So I think we're going to end on time, at least with what I had to share, and then I'll be here available for questions right after that. So here we go. How to invest for medium-term goals. The other common question that I've been getting, which I can't help but notice, is share platforms where you can use to invest money. So after this masterclass, as a part of the 6 free tools that I share with you, I will also be sharing with you a step-by-step guide on different platforms. And I'm going to select the few most common ones. So that includes Zerodha, Grow. Then it includes something called as MF Central, which is not a privately held for a profit entity like Zerodha or Grow. They still make money, but they are a direct to mutual fund. They have the direct to mutual fund approach. I'll also be sharing how you can set up an SIP using CAMs. So all of this will be available to you. I'm selecting these 4 predominantly simply because they have the most number of users. I don't have any affiliation to any of these companies, and here we go. Back to the course. So when you're investing for between 3 and 6 years, it's that in between time where you can't really risk the money in the stock market entirely, because what if you need the money, right? In between, we have seen how money in the stock market may not grow over a period of 3 years, how you could get negative returns in that period. But at the same time, you don't want to be too cautious, because if you're too cautious, then you're potentially losing out on gains, because 5 years is still a long time when it comes to investing. So with that being said, you should first focus on safety. So safety first approach, that is something that absolutely needs to be ingrained into uh, selecting funds for this goal. Then you should also consider taxes. So if you're investing in an out and out debt fund or an FD or things like that, it's just going to be taxed very heavily. So post tax returns are going to be 5-6% at the most. And then there should be some level of growth. And the way you do that is by adding a small allocation to stocks in your portfolio, and then you would go about it. So with that being said, with these 3 points in mind, here's the guide to invest for your 3 to 6 year goals. Sharing the guide once again. So before I share the fund names, I want you to specifically look at this, right? So out of the money that they're investing in, how much is going into equities and debt? That becomes very, very important with something like this. And let me just quickly make it more palatable to look at. So if you look at equity investing, this first fund, out of the 100 rupees that it invests, only 23% is going into equities. The rest is going into bonds. And yet, that fund has performed supremely well, right? 12.74% returns for a mutual fund that is holding over 70% bonds. Absolutely fabulous. But these bonds give you an inbuilt safety, a baked in safety in the portfolio, because think of it, if tomorrow the market falls by 20% and you only have 20% or 25% in this case in equities, then you have 25 rupees in equities, and the fall is going to be essentially about 5 rupees only, whereas the rest of the portfolio is going to get pulled up because of the bonds. So this breakdown becomes very important when you're investing for goals between 3 and 6 years, and that's where it becomes absolutely critical for you to just be mindful of this particular aspect. Having said that, here we go, right? These are the funds. As you can see, they have the name hybrid in them, they have the word conservative in them, and all of them essentially belong to the conservative hybrid category. That means that debt or a bond is significantly more in the portfolio of that mutual fund than equities. There are percentages of it. I'm not going to get into the specifics of it because it doesn't really matter. Uh, so these are the 4 funds for your 3 to 6 year goals. Uh, the filtering criteria that we have used here once again is having a minimum threshold of assets under management. As you can see, all of them manage multiple thousand crores, which is fantastic. And then we have the 3 year rolling returns once again. And if you want to figure out where to invest, one of the best ways is to essentially look at 3 year rolling returns, 5 year rolling returns. Rolling returns give you, if you're wondering as to what rolling returns are, oh, I didn't realize that the screen was small. So sorry for that. There you go. Is this properly visible now? Okay, you can see it now. Superb. So I quickly just go through that one point in 30 seconds once again because the screen was small. I didn't realize my screen was small then. Uh, when you're investing in mutual funds for 3 to 6 year goals, you want to have more bonds in your portfolio. So by having these bonds here of over 60-65%, the portfolio is becoming very stable. You have about around 25% or equity in that portfolio, which is what powers this growth, right? Over 5 and 10 years, if you look at the annualized returns at about 10%. Can you imagine a portfolio that has about 60-65% debt is giving you over 10% returns? So keep that in mind. And these are the 4 funds, right? Kotak, HDFC, SBI, and ICICI Prudential Regular Savings Fund. We tend to use these for our clients as well. I personally don't have money for 3 to 6 year goals in my portfolio, but for a lot of clients, we use these funds. If you notice, Again, very good returns, and one of the best ways to look at again mutual fund performance is rolling returns, because rolling returns give you an idea as to if a fund has been consistent in the way it is performing. So if you really want to fine tune, these are two funds that you can absolutely go out and invest for a 3 to 6 year goal. But once again, because it has some equity in it, you should be mindful of the fact that its value may tend to go down as the if the market's not doing well, but it wouldn't fall drastically like a 40-50% drop if the markets are not doing well because of that big 65-70% allocation. So keep that in mind. What are rolling returns? Someone is asking me. So rolling returns, think of it as two types of returns, broadly speaking. One is CAGR, or compounded annual growth return, which is return from, let's say, if I invested 10 years ago on 27th April 2014, if the value was 100 rupees, today the value is 200 rupees. So from 100 to 200, what is the exact return? Absolutely, it has grown by 100%, correct? Annually, that would have grown by about, over 10 years, I'm thinking about 7.5% or so. Rolling returns, on the other hand, don't look at just two values, not from 27th April 2014 to 27th April 2024. They don't look at two isolated values. They look at all other dates in the middle. So if it's a 3-year rolling return, it would look at returns between April 27th, 2014 to April 27th, 2017. 28th April 2014 to 28th April 2017. So we look at 3-year blocks from date to date, and then when I'm sharing this particular table with you, it is the average of those rolling returns. So if you notice, if a fund does not do well in a 3-year period, whereas if it does very well in a 3-year period, that gets baked into rolling returns, which is extremely important. So there you have it. That's how you would select your funds for your long-term goals. Now, one point that is left, which is again important, is to actually share with you how you can use a very important tool that will be shared with you right at the end of this particular course. So just hang on for a couple of minutes and I will be sharing it with you. There you go, right? So can you see this? We went through this one right now. And finally, we have this. How can you achieve all these goals through an SIP if you are starting an SIP at the age of 30? Can you all tell me in the comments, what is the SIP amount that you currently have going? How much do you invest per month in an SIP? Can you tell me that? As you share that, I'm going to share this tool with you and how it works. And with that, we will be, there you go. Can you see this on the screen? Are these values visible to you? I could zoom in. The way now you're going to get this tool, by the way, you're going to get this Excel sheet. A lot of you are investing between 5,000, 20,000. Someone's doing 2.4 lakhs. Someone's doing 1 lakh. Absolutely fantastic. Hopefully, after this particular masterclass, you will have more confidence in increasing that amount, in knowing where to invest, and also broader financial planning, which is what you would find here, right? So first up, you can just, once you get this sheet, you can enter your SIP amount, what you're doing currently or what you could do, even if you're not doing it currently, your estimated return, how many years do you plan to invest for? And over here in this section, just enter your age. So it could be 25, let's say. And everything will get auto-calculated in the sheet, right? You could enter a higher age as well, right? 40, and again get auto-calculated. So let's just start with 30 as the age, because I've realized that's a sweet spot between my audience. Some people are under that, some people are over that, but majority are in that 28-32 category. So when you start an SIP to plan for your overall portfolio and long-term goals, I want you to not really think about pulling out money for the first 3-4 years of that investment. You can pull money out if it's a very high SIP amount, but if you really want to plan for all your goals, you don't want to pull money out for the first few years of having that SIP. The reason for that is because I'm going to zoom out just a bit. If you notice, if you start at 30 with a 30,000 rupee SIP, and here's what a step up SIP is, right? After the first 12 months, you increase it by 10%, that amount. Now, some people wonder if 10% is possible. If it's not, you can just again play around with the annual step up percentage. You can reduce it to whatever number, increase it to whatever number. But in my experience, if uh, it doesn't have to be a 10% yearly increase, but let's say you switch a company and get a 50% hike, that also gets baked into these calculations, because when you get that 50% hike, 30% hike, 100% hike, you're going to invest significantly more money. So it's kind of averaged out, doesn't have to be every year. But just look at how this money, the investment amount grows, right? From 30 to 33,000. Here's where it gets interesting. So if you want 75,000 rupees for a vacation after 4 years or after 5 years, right? In this case, after 60 months, that is going to be at a 10% inflation, actually be worth 1.21 lakhs. So you have this particular investment number here, correct? I'm just going to highlight it and see if it gets, there you go. Now from this number, essentially your investment amount or the need of 1.21 lakhs gets debited. So you are placing that debit order and the money gets credited to your account. You can use it. In this portfolio, it's happening every single year after that age until you retire. 75,000 adjusted for inflation. If you notice, once again here, rather it's 50,000. Sorry, there you go. There you go. That was one number. It's 50,000 here. So 50,000 rupees adjusted for inflation, 81,000 in the first year, 89, almost 90,000 in the second year, and it keeps going up. If you notice, 98,000. Next up, I have a car down payment here of 2.25 lakhs. Why 2.25? Because the car cost that I've assumed here is 7.5 lakhs. So you pay 30% as down payment. At that stage, 6 years later, the value of it will be 4 lakhs at a 10% inflation. And if you notice, we keep doing that. We buy a house in the middle as well, where you pay 86 lakhs as down payment. You keep going down, you keep going down. There is kids' education as well. So you withdraw 2 lakh rupees, which is worth 24 lakhs. You do it for 4 years. If you have multiple kids, you can add those particular expenses. And essentially, this sheet will give you a very good idea as to how much money you would need for all your goals, including retirement. So with that, we have come to the end of our particular masterclass. We will be going through question answers right now. And before we sign off, right, I want you to just think about all the things that you are confused about for a second. If what we did has been helpful, and any questions that you have, any doubts that you have, I'm here for you. So you can go ahead and start asking me. In the comments, we will be going through multiple things, multiple questions. So just give me one more second. I have something else to share with you. Just give me 1 second. There you go. Just give me one more second. So sorry. So for all of you here who have tuned in for this particular masterclass, there is something special that is coming up for you. I have mentioned this while we on stories multiple times over the last few months, but we have made a health insurance plan selection tool. So based on your profile, you can essentially choose that profile, and basis that you can select whichever plan is right for you. You get a video walkthrough of me explaining how those plans work, and this is my 9+ years of experience in this particular field of just helping people find insurance packed for you in this particular tool. The tools that I have shared with you today, I'll be sharing them with you tonight, so you can go through them. Whereas for this particular masterclass, you will get that in just a second. What I'm dropping though in the comments box is a tool that you can use to find the right health insurance plans. And let me just share that here. So there you go. I have pinned this link, sorry. For all of you here, this is something that we are rolling out. It's a health insurance plan selection tool where within 20 minutes, you will know which plan to buy, no matter who you are, no matter who you can get the plan for, elderly parents, whether it's you. You can go access this tool at healthinsurance.udayan@they.com. You can check it out, and that would be available to you. It's priced at $9.99 currently, but we will be increasing the prices for those who have not attended this particular masterclass in the next 24 hours. So to check that out, we'll be sharing all the links, all the tools, the health insurance course details as well, and we'll be going through that. Let's get to answering questions so that it is available to you. 1 second. Let me just there you go. All right. Today's tools will be shared with you tonight. You can access them, and now we'll get to answering questions. So a lot of you are asking me about small cap, mid cap stocks, small cap, mid cap mutual funds. They ideally should be a part of your portfolio, yes, for 10+ year goals, because they tend to be more volatile in the short term. And how to go about selecting them requires at best a couple of hours, because we really need to drill down into a lot of other factors and also look at portfolio composition. So that won't be a part of this particular masterclass, but believe me, just with index funds, the ones that we have discussed, you're going to you're going to basically build your entire portfolio with just them. Someone is asking me here, flexi cap mutual funds. So flexi cap mutual funds, by definition, they are mutual funds that have no guideline as to how much they need to invest in large cap stocks, mid cap stocks, small cap stocks. They can keep moving around, and most flexi cap funds tend to have a very high large cap allocation in them. Again, how to select flexi cap funds becomes a very nuanced topic, because it's not a straightforward question. You need to look at several factors, which will be covered in a future class like this. Mamta is asking me, and I'm going to star that here. I think this is a good way to go about this. 1 second. Yeah. What are your thoughts on chit funds and SIPs? Chit funds, I would technically, there are some clients who do invest in chit funds, but we have managed to move them away entirely from chit funds, because chit funds are risky at the end of the day. Very tricky space to operate in. So wouldn't advise investing in them. Then we have one more question here of where to invest for emergency funds or withdrawal within 1 year. If you're investing, if you have an income of about 7.5 lakhs, arbitrage funds, you can use the fund selection tool to know which those funds are. Kotak, SBI, Invesco, good options off the top of my head. If your income is less than 7.5 lakhs, I would recommend you consider a short-term debt fund. So ICICI short-term debt fund or HDFC short-term debt fund, good options to have in your portfolio. Then we have so Abhay is asking me step up versus starting a new SIP in the same fund. Which one is better considering compounding and compound interest? Now, with this, Abhay, look, step up SIP as a concept sounds wonderful, right? When you're setting up that SIP on certain platforms, you can enter that step up amount that every year increase it by 5%, 10%, 20%, and it will automatically start debiting that higher amount as the years roll. But in theory, what ends up happening is that your income rise is not 5%, 10%. It could be lower, it could be higher. So, whether you should start a new fund to increase that amount, this really depends. So, and depends on a few things. So, firstly, is your investing goal, has that changed? Is that something that so do you still need money for a goal that is 6+ years away, or do you need that money for a 3-year goal? If it's a 3-year goal, you don't want to be investing in that same equity fund. You want to invest in one of the funds that I mentioned and through the tool. That's number one. Number two, if it's the same goal, right? If you want to keep investing for your retirement or long-term goals, then if it's an index fund, just keep investing in an index fund. If you don't have a mid-cap fund, add a mid-cap fund maybe. But compounding in a way does not get affected if you say switch between equity funds, because at the end of the day, you're investing in the Indian stock market. If that market grows, your funds would also grow. Right. Then we have just one second. There was a fund. There's one question here from Nimish. He says, how much emergency fund to set aside? So when it comes to emergency funds, if you don't have anything at the moment, aim to set aside 1 month of expense. That is it. That should be your first goal. Once you get there, increase that to 3 months. Ideally, over a 2.5, 3-year period, if that's possible, you want to get to a place where you have 6 to 12 months of absolute must-have expenses that are always saved in a very safe place. So that becomes your emergency fund. But if you, let's say you're spending 30,000 rupees per month. So 6 months of that is almost 2 lakhs, right? 1.8 lakhs. 2 lakhs may seem like a very large goal if you're just starting out. But if your goal is 30,000 rupees or 60,000 rupees, you're more likely to achieve it. So you just feel better about that process, which again, the behavioral aspect of investing is something that most don't focus on. But when it comes to actually investing money, you need to focus on it. So start off with a 1 month, 3 months, 6 months, increase that, eventually get to between 6 and 12 months. How much should you keep aside? An amount that makes you feel safe in your mind. If knowing having 6 months of expenses is going to help you out, then just keep that money aside. It's going to be useful. Suprita is asking me, is expense ratio calculated monthly or yearly? At the end of every month, the portfolio value is considered, and then let's say your expense ratio is 0.96% for the year. That means 0.08% for the month. So whatever is the monthly amount, it gets debited, and that's how the expense ratio gets calculated. So there you go. One more question here. Can we transfer mutual funds from hybrid to Nifty 50 index funds? A transfer is possible in 2 ways. One is you sell the fund, the first fund, the proceeds you have got from it, invest that in the target fund. So let's say you sell hybrid fund, you put that money freshly in a Nifty 50 index fund. The other way to do it is what is called as a switch transaction. So switch transaction is possible. Let's say if you have a SBI hybrid fund, to move it to an SBI Nifty 50 index fund, or an HDFC hybrid fund to an HDFC Nifty 50 index fund. The difference between the two is that in a switch, the money doesn't hit your account. It gets internally transferred or switched. It still is a taxable event. You still have to pay tax on it because it's a buy and sell transaction. So keep that in mind. Then let's scroll down to newer comments. I'm investing, Rajnikant says, 40,000 rupees per month. Option 1, invest 40,000 in the same fund. Option 2, invest it in 4 different funds. Now, again, look, most people are going to benefit from having, say, exposure to large cap, mid cap, and small cap for long term goals. In this particular masterclass, I've told you how to go about large cap investing, which is through the index funds that I've shared in the tool. How can you then select, say, mid cap and small cap funds? You can select index funds for that as well, use the same principles of expense ratio. Or you can directly buy a BSE 500 index fund. A BSE 500 index fund invests in India's 500 biggest stocks. So that's how it gets its name, 500. So that is one way if you want just one fund. I would ideally have 40,000 if I'm investing, about 25,000 that goes into a Nifty 50 index fund, and the remaining 15,000 into mid and small cap funds. The link to the tools, I'll be sending a fresh email to you with all the links so that you can have them in one place. All the Excel calculators, all of them would be shared with you in that one email. At the same time, we'll be doing a live replay of this particular masterclass, so we will be going through that. Pratibha is saying, is there a mutual fund where we can get a monthly income? This is possible in any mutual fund through what is called as a systematic withdrawal plan, or SWP. Just like there's an SIP, there's a systematic withdrawal plan, SWP. And in it, you just tell the mutual fund that every day, every month on this date, I want X thousand rupees. So let's say you have 1 lakh rupees invested, and you tell the mutual fund every first of every month, I want 2,000 rupees from it. So that 2,000 rupees starts getting debited from your mutual fund. Ideally, if you want to draw income from mutual funds, you want to make sure that the 1 lakh that you invested does not get exhausted. So that is something that again becomes part of a larger financial plan, and again requires a different masterclass by itself. So by the link that you can see here, right, healthinsurance.udayanadhe.com, by heading to that link, you can access a health insurance tool that I have built that tells you exactly which plan you can select and opt for, no matter what your profile. So you could be under 65, absolutely healthy. You could have diabetes, BP. Your parents could have diabetes, BP. You want a plan for them. We have built this tool specifically, and for those of you who are attending this masterclass, we are giving a 50% discount. So you can buy it there. It's for 999 rupees. It's something that you can, it's available to you pre-recorded. Next Saturday, we'll be hosting our first live session for it. And after the live session, you can get the pre-recorded material as well, including that health insurance tool. So you can go through, you can find more information about it. And it also really makes me happy to also share that for every course that is bought, we'll be donating 1 meal to a school-going child. We're going to match it 1 for 1, and we're very excited to do that. Rishi is asking me, what is a better investment, regular plan or a direct SIP? What is the difference between the two? Through a regular plan, you're investing through an intermediary called as a mutual fund distributor. So the fee that you pay that distributor is higher as opposed to a direct plan where there is no intermediary. You're directly investing with the mutual fund house. Now, if you really look at just the numbers, a direct plan has lower fees. So returns wise, it is a better proposition. But having said that, I would really, really recommend all of you who are not sure about how to invest to actually work with either a mutual fund distributor or a SEBI registered investment advisor. I work as a mutual fund distributor. That means I don't charge a flat fee for a consultation. Instead, I get paid a certain percentage of your investments every year. So with that disclosure being shared, whether you should select whether you should invest in a regular or a direct plan really comes down to if you need guidance. If you need guidance, work with a good mutual fund distributor. How to find a good mutual fund distributor or a SEBI registered investment advisor? Ask around in your friend and family circle. If they are happy with someone, work with them. Because even though you'd pay that 0.5% more, 0.7, 0.8% more in fees every year, you're just going to invest in better places. You're going to make sure you're investing as much as you can, which will eventually give you more returns despite that fee in place. So I'm going to invite you to think about investing in creators, influencers. They and absolutely disregard regular plans. They say, why are you paying that fees? Ground reality is different. Can someone handhold you through your investing journey? If that is possible, that gives you confidence, opt for a regular plan through a distributor, or go with a investment advisor. But investment advisors are also expensive. You pay them 10, 15, 20, 30, 1 lakh rupees a year, depending on how experienced they are. So let's go through a few more questions. This is one question that Sabrinath is asking. Which is better, Nifty 50 or Sensex index funds? Very similar to each other. I would just say pick Nifty 50 index funds simply because there are more of them available. So you have a choice to make from. But even if you select a Sensex index fund, it's not going to really matter in terms of returns because most of the money gets invested in very similar places in the two. There is Deepesh who's asking, can we invest lump sum amount in index funds despite the market being up currently? Very important question, very good question, Deepesh. Should you be investing when the market is up or should you wait for the market to fall? I'm going to share one piece of data with you. We're making a video on it as well, but one piece of data with you. Over the last 40 odd years that the Indian market has been in existence, the market has hit an all-time high in all years except about 5 or 6. Think about it. Out of the 40 years, the market has hit an all-time high 34, 35 times. Now, if you only did not invest just because the market was at an high, you wouldn't have invested for 34 years in the past 40 years. And you wouldn't have been able to enjoy that compounding benefit. So how can you be strategic about this? If you don't need that money in the next 6 years, just invest that money. Don't think about it. If you need that money in 3 to 6 years, use the conservative funds, hybrid funds that I've mentioned. Less than 3 years, use the arbitrage funds that I mentioned. That same philosophy applies even to invest when the market is up. Let's go through newer comments. Raghav asks the question, is Nifty 50 alone enough for long-term investing or do we need diversification? So in a complete portfolio, Raghav, you will have some mid caps and small caps as well in your portfolio. This can also be through index funds. But if you only have Nifty 50 index funds, even then your portfolio value is going to, if the Indian markets do well, going to keep going up. Because the Nifty 50 index fund, if you were there in the earlier part of the masterclass, you would know that the 50 stocks in the Nifty 50 index, they keep rotating. Stocks present 10 years back are not the same stocks present today. So you automatically are buying and selling stocks. You just don't know about it because it's through a mutual fund. So that alone is enough. Don't let only that stop you from investing. Through future masterclasses like this, we'll be covering how to invest in small and mid caps as well. So because that requires time. We have already, I think my sharing of knowledge took about 2 hours, a little about that. We're already about half an hour into answering questions. So we'll have a separate masterclass for that. Someone's asking me, Prateek, do you and your team help and manage portfolios? Yes, we do work with clients one-on-one. Just because we need to dedicate enough time to each and every person that we work with, we don't want to be one of those who has 1,000 clients and we can't do justice to all. We have certain minimums in place. Those minimums are if you can do an SIP of 50,000 rupees or a lump sum of 20 lakh rupees, then we're specifically working with those clients right now. For everything else, for anything lower than that, such masterclasses, such events, things that we are doing in the future, all of those become important, and you can basically act based on the information shared here. One second. We're going to take about 5-6 more questions, I think, and then call it a day because my throat is absolutely whacked. I don't know if you can tell it from my sound. Abhay is asking me a question. How to switch from a 3-year-old regular mutual fund to a direct mutual fund without impacting current compounding interest? So, Abhay, when you're moving from one fund to the other, two things to be careful of. If it's a switch transaction, if it's a redemption and a buy transaction, it's going to be a taxable event, number one. So, if you have made gains on your previous mutual fund, you have to pay proportionate tax on it. If it's an equity mutual fund, all gains that are more than a year away, or I'm guessing it's not a SIP transaction. So, for the first 1 lakh, you don't pay any tax on that gain. If it's more than 1 lakh the gain, then in the additional amount you pay a 10% tax if you held that investment for more than 1 year, which has been the case here. So taxation out of the way, you have to pay tax, you have to be mindful of it. Secondly, will it affect current compounding interest? It won't really, because if you think about it, it's like you have right, this one glass and this one container of water. You have some water in this glass, in this container. You're essentially pouring that into this container, which is also investing in the Indian stock market. This was also investing in the Indian stock market. So if I'm also pouring this back and switching it from one fund to the other, as long as I'm investing in equities, it's getting invested in the same place. So compounding won't really get affected, but be mindful of your taxes that you'd have to pay. One question here from Debesh: are NFOs a good investing option? Stay away from NFOs for several reasons. Firstly, I'm a mutual fund distributor, right? So when there's an NFO coming up, the mutual fund first contacts me and tells me that there's an NFO that is coming up. Ask your clients to invest in it. I am incentivized to sell it to my clients. So generally, if someone is incentivized to sell you something, not a good place to start, number one. As a principle, we never ever ask our clients to invest in NFOs because of that. Number two, NFOs tend to come up in places in the stock market that are doing very, very well. So let's say manufacturing, defense, those are the NFOs that you will see coming up right now. Sorry for that. So in that case, because these are hot sectors to invest in, typically what tends to happen is that these are sectors that have already run up, where the price increase has already happened. So if there's an NFO that comes in, it may not enjoy the future gains that take place. So I'm going to increase the AC temperature because I realized it was getting slightly stuffy. So don't invest in NFOs for all those reasons. There are enough funds available that are not NFOs that are investing in the same place where that NFO is doing, investing in. Thirdly, to round off this point, with an NFO, if a fund is investing in a new place, it becomes very difficult to track the potential performance of that fund, because if there's a long track record of a fund in place, it just becomes easier and you can be more confident while investing in it. Aditya is asking, what about gold investments? I am a huge fan of having 5-10% of your money, overall money, in gold, simply because it's a wonderful way to diversify your investments. If you look at the past 5 years, gold has actually done better than the Nifty 50 index. If you look at the past 20 years, if you'd invested one-time lump sum amount, I think 23 years ago, gold has still done better than stocks. If it's an SIP, gold hasn't done better than stocks. But forget returns for a second. Think about it from a diversification perspective. Even though it hasn't happened in the past 2 years, gold performs better when stocks aren't performing better. In the past 2 years, everything's performing well. So wonderful way to hedge your investments, diversify. How to invest in gold? Have sovereign gold bonds. I love them because you don't pay tax on their maturity if you hold them for the entire 8-year period. And here's the hack, right? You don't need to hold them for 8 years to enjoy the tax-free gain. On the stock exchange, you can buy a bond today that's expiring or maturing in 5 years, that was floated 3 years ago. Hold that for the remaining 5 year tenure or 4 year tenure, and you still get to enjoy the tax benefits. That's a hack not many people know about. Those of you who have stuck on, I think we were at 2,300 in terms of total attendees. About 600, 700 of you are here. So 30%, which is wonderful. So that's the nugget that you get for having stayed so long. As we'll take the final two questions, if you head to healthinsurance.udayan.com, you can register for our live session next Saturday, same time at 4 p.m., where we talk about health insurance. For those of you who are attending this session right now, we are slashing the price by 50% to 999 rupees. So it's a special discount available to you. So go check it out. I'll be sharing the link in an email later as well, along with all the other tools that I share with you. As a part of this tool and course, what you get access to is all the concepts of health insurance. How can you get a 1 crore cover, for example, for 5,000 rupees? How can you reduce your health insurance premium by 20% every year? Which plans to select? Actual names, like I shared actual names with you right now of different mutual funds. We have made a custom tool based on all my years of experience, where based on your profile, your budget, you'll get to know which plans to buy. In fact, let me see if I can share my screen and give you a quick access to how that tool looks like. Just 1 second, let me see. There you go, right? So I'll share something. Let me see if I can share this. Share screen and share my entire screen. I think that would be the most effective. Sorry for that. Inception like small. So here we go, right? So this is the health insurance plan selection tool. And essentially you just click on one profile. That is it. You click on this profile and then you get a feature by feature comparison. Not just that, but a video walkthrough of me sharing how these plans compare against each other, what you should be looking at when you're buying these plans. So all that is available as a part of our offering here, healthinsurance.udayan.com. It'll be wonderful if you can subscribe to our YouTube channel as well. Our first long form video was something I'm very, very excited about. Goes live tomorrow. There's a lot more coming up on the YouTube page. I personally have learned a lot from YouTube over the years, different fields. So I'm very excited to really launch the first video, and we'll be launching a new video every Sunday morning. Here's one question. Please advise for 50-plus-year-olds what strategy to be followed. So, Mr. Roy, you want to take care of a few things, right? Firstly, look at if you have any big loans, debt that is coming up or that is yet to be paid. Ask yourself if you can pay it before you retire. Because after retiring, paying debt becomes very difficult. Secondly, you want to be also very careful of how much money you want to have saved up for retirement. Now you're 50 years old. I'm going to share one more very important point that, again, for those of you who have stuck around for so long, very grateful for it, but you can walk away with this. As a 50, 60-year-old, how much money do you need to actually retire? If you think about it, because that's a big goal to have. Because once income stops, you need to be careful of the money that you spend. Look at the money that you need in terms of annual expenses, right? So let's say you have 3 crore rupees that you have saved up. 3% of that 3 crores is what you can withdraw as annual expenses. So if you have 3 crores, you're withdrawing 3% of it, which is 9 lakhs, which is about 80 to 90,000 rupees. You can withdraw that per month, inflation adjusted, for the next 35 years. This is as per the Indian context, 3 to 3.5%. That's what you want to be aware of. for someone who is 50 years old. Secondly, if you're not used to investing in the stock market, I would recommend adding 15-20% of your investments to the stock market through equity mutual funds, because you need them even during retirement. Even during retirement, you want to have, if you retire at 60, you have 35 years to live off your investments. You need 25-30% of your money to be invested in the stock market for you to sustain and beat inflation. Keep that in mind. Subro is asking me how to decide how much to invest in SIPs based on monthly and yearly income. There's no one right answer to this, Subro, because everyone has a different things happening in their life. As a broad number, ask yourself if you can invest 30% of your monthly income. If you can do that, that's fantastic, because 30% is a large amount of money, right? So that's fantastic. At the same time, figure out, there's one more way to go about it. Let me share my screen, and that will also give you an idea as to how you can, right? So let's say you need in 1 year, you need 1 lakh rupees. You're going to get this tool, by the way, later on. You know you need to invest 9,000 rupees per month to get to this 1 lakh. You know that needs to happen. So that's one way. You calculate backwards how much money you would need, and then you'd start investing that. I'm not a big fan of this. Invest as much as you can potentially do. So if you can invest 10,000 rupees per month, see if you can invest 11,000 rupees, 12,000 rupees. Just stretch yourself. It's one of the best ways to go about investing. I'm looking at more questions here. A lot of questions. We're trying to figure out if Sachin, you're saying great content. I'm glad this was helpful. Honestly, everyone, was this masterclass helpful? Let me know in the comments. Do you think it's something that you got a lot of value from? It's something that you enjoy. It's something that actually make a difference. Let me know in the comments. I think we'll take one more question before my voice absolutely goes away. We'll be sharing a feedback form with all of you in that same email where you get all the tools. So if you can let me know how this session was, what we can improve on the next time we hold something like this, it would be lovely. One final question before we call it a day. Trying to figure out which one to answer, because we'll answer two questions because this is a short answer. Pratik is asking me, I want to invest 10,000 rupees. Okay, I tagged the wrong question, but we'll answer this. I want to invest 10,000 rupees through an SIP. Which fund should I consider? I'm 22 years old. 22 years old. I have all my goals 5-year onwards. Pratik, you want to look at essentially either out and out index funds, or you want to look at conservative hybrid funds. Because you have a long-term investment horizon, index funds would be the way to go. If you're new to investing, you don't want to get scarred in the process, because if you start investing today, next year the markets don't do well, that is going to be your impression of how the stock market is. So if you're new, I always share with my clients one simple analogy. When you're investing, think of it as you are learning how to swim. You first go to the baby pool, then you go to the 4-foot pool where you have a float on. Once you're comfortable there, then you dive into the 7-foot pool. Similarly, when you're investing, that 10,000 rupee SIP, if I was in your place, I would invest about 3,000 or 4,000 rupees in a conservative hybrid fund and the remaining 6,000-7,000 rupees in a Nifty 50 index fund. If you're absolutely confident of if you're being able to handle stock market volatility, the up and down nature, invest all of it in a Nifty 50 index fund. But if you're unsure, split it between a conservative hybrid fund and a Nifty 50 index fund. Someone's asking me, can I share my ticker tape page? Let me see if it's available right now. If it's loading, just 1 second. Let me see if it's opening before I start sharing my screen. One second. Let me see if I can open ticker tape elsewhere. Just 1 second. I have pinned a comment here with the access to my health insurance masterclass and course. Will be happening next Saturday, the first masterclass, and you will get all pre-recorded other educational videos around health insurance as well, along with a recommendation tool that you can use to know which health insurance plan to buy. So let me just figure out ticker tape. I don't know why ticker tape is not loading at all at my end. Okay, great. It started loading. Super. Let me share my screen. Let me share my screen. Okay, can you see this? Superb. So here are my saved screens. So if you look at index funds, let's look at the category, what the filters that I've used, right? So for example, AUM is 1,000 crores. So if I remove this, you'll see the number of index funds is just crazy high. There are index funds with 3, 5, 17 crores, 38 crores. They'll eventually grow to a higher amount, but we want to have this filter of at least 1,000 in place. So keep that in mind. There you go. So significantly the number reduces, and what we also have here is tracking error, TER. We can also add, for example, inception, right? Times in inception, that can be 24 months. Right, so you can see index funds of different lengths, 136 months, if Navi's closing in on 3 years. So there you go. This is how my ticker tape looks like. Then we have, let's say, conservative hybrid funds, right? The filters that we have used are firstly hybrid funds, except for arbitrage. That's what we have selected. Then we have AUM of at least 2,000 crores, times its inception of 24 months. So it should be 2 years old at least. And then we have debt holdings. Anyway, a conservative hybrid fund has that in place. So there you go. So debt holdings should be at least 60%. Right? So there you go, 60%. And equity holding, the way I filtered it out initially was I had put the equity holding as maximum of 30%. So automatically it selects conservative hybrid funds then. Finally, we have arbitrage funds. So for arbitrage funds, we have again 10,000 crores as the metric and 5 years since inception. Those are two good factors to have. And then finally, we get these. So in the fund selection tool, the filtered funds would be based on these filters. And you can also check those out if you have ticker tape, if you want to play around with this. Okay. I think we are going to conclude the session now. We are closing in on 3 hours. If you have any more questions, we want to host similar such masterclasses in the future. And I'm very excited to host them in the future as well. This was a wonderful first experience. Hopefully, you learned a lot. If you have any questions about the health insurance course, I'm going to hang around for a couple of more minutes, and then we will call it a day today. But this was a pleasure. my first such live session, and all of you made it super, super special for me by showing up in such large numbers. There will be people who will watch replays of this as well, and extremely, extremely fulfilling to be here with all of you. Thank you so much for making my day. If you have questions about the health insurance course, please do ask me. It's something that we've put a lot of time and effort and energy into, and hopefully it shows in how we have gone about doing it. So let me, in fact, quickly share my screen one last time to take you through what that course is about. So, it starts on the content goes live on Saturday, 4th of May, and you can get it for 999 rupees at the moment. If you're confused about any health insurance concept, if you're afraid of your claims getting rejected, then we cover all of that in this course. The biggest sort of most important feature in this course is the custom health insurance plan selection tool. So based on your profile, you'll get to know which 3 to 4 plans you can opt for, along with my video comparison of how they stack up against each other. We'll have monthly live Q&A sessions wherein similar kind of a setting, you can ask me any question that you want. We'll be holding those via Zoom. What I'm very, very excited about is this part, where for every course that is bought, one meal is donated to a child in need. Very excited about this to share with all of you, let's say in a month's time, as to how many meals we have donated. And first module covers insider secrets. So can you get a 1 crore insurance for 5,000 rupees? Can you get health insurance plan free by getting your health insurance to pay for itself? Can you get a 20-30% discount? The plan selection tool has, I think, the biggest advantage. I don't think there's anything like that in India today. And you can go through different frequently asked questions, and you can just press enroll now and you will be taken live. So there you have it. Thank you so much for tuning in. And a lot of questions. I'm going to just check once more. Mr. Wadiwala is asking me, he is 61 years old, his wife is 54. What do you suggest? For anyone who already has a health insurance plan, the course becomes relevant if you are unsure whether your plan is good or not. Or if you want to know which are the best plans available to you for your profile, for your age, for your budget, that's where the course tool becomes effective. You can buy, let's say, 1 year subscription and check out for once if the plans add up, because if you do realize that there is something that is lower in cost but better in features, then that would be wonderful to have, right? It's the best of both worlds, lower cost out of pocket, higher benefits that you get. But if you're absolutely sure that you have a good health insurance plan, you're happy with it, don't care about this course. It's only for people who are not sure about it, who don't have health insurance, who want to know what is available, which are the best plans. This course is for them. So thank you so much. Thank you so much, everyone. Looking forward to hanging out with all of you very soon. And remember, every Friday next week onwards, you'll be getting a free email newsletter. We wanted to also send it on WhatsApp, but that's going to take some time. You've shared your WhatsApp numbers with me for that purpose. So we will be sharing that newsletter over there as well, maybe once a month to begin with, because if we send out too many messages on WhatsApp thinks we are spamming people, so they block us. So that's why we couldn't even send alerts for this masterclass on WhatsApp, because that would have been a too high a number. I think the last I checked, 14,700 of you had signed up for this. So that's why we couldn't do this on WhatsApp, the reminders. But watch out for my newsletter every Friday in your inbox, email inbox right now, later on WhatsApp. So keep that in mind. And with that, I think we are going to call it a day, and we are going to see each other very soon. Thank you so much. You've stuck around with me for 3 hours. Remember to check out my health insurance course, goes live next Saturday. The first session is live on Saturday, and then you get all the pre-recorded videos right after that. Keep that in mind. Thank you so much for making my evening, and hopefully I helped you out. All the links, all the tools that I have spoken about, including a feedback form where you tell us what we can improve on, what you liked, will be shared with you tonight in a separate email. So watch out for it. Have a great Sunday, and I will see you soon.